Further loosening of virus measures after Europe's largest economy records the biggest spike in cases for nearly 4 months. And Asian stocks trade mixed following a fresh record on Wall Street, but the dollar slides on signs that the size of the next round of US stimulus may be smaller than expected. European futures point to a positive open. Welcome back to the programme, everybody. So here on the European market open, just a few seconds to go, really, until we get those European equity markets opening. And futures have been suggesting we will be a little stronger, perhaps, but really not much in it. In fact, either side of the flat line now. The CAC 40 futures were suggesting a little bit of weakness. FTSE futures a little bit higher. DAX futures a little bit weaker. So we will see where we end up as these European equity markets get out of the gates. We've got the FTSE 4U just down by 0.1%. The IBEX over in Spain also down by around 0.1%. So we've got a couple of markets opening to the downside. We've got a real focus on inflation. Today we had numbers out from the UK a little bit earlier on. The CPI inflation number coming in higher than had been anticipated. We'll get the European numbers a little bit later on as well. We've had a bit of earnings news to deal with. We had numbers coming through from AP Muller-Maersk. I can tell you that that stock is really flying up by 6.6%, up nearly 7% in fact, as the company reinstated its guidance and actually issued better guidance than it had previously had to withdraw. So that perhaps being seen as a real positive for these markets. We are in a bit of a sort of August lull, though, in terms of the earnings season, the volumes coming through here. But European equity markets lacking then a little bit of direction as we start the trading session, just down 1/8% or so. That is after CPI data in the UK showed inflation rising faster than expected, and signs that the US may pursue a narrower stimulus bill fueled a rally in the pound and euro. The single currency is holding near a 2-year high against the greenback. We're joined now by Jane Foley, Head of FX Strategy at Rabobank. Jane, really good to speak to you. Let me start with some of the themes around Europe that may or may not be moving risk assets at the moment. And one of those is around the underlying virus. We've been tracking this uptick in virus cases in Germany in particular, the measures being taken in Greece, in Spain, in Italy, to clamp down just a little once again on movement. Are you concerned that we're back into even localized lockdowns later on in the year? What will that do to the euro, do you think, if we end up in that if that becomes the narrative?
Well, yeah, the euro could be vulnerable to this because I think as it stands, the lockdowns that we're having are considered to be really quite pragmatic, quite sensible in order to keep on top of the virus. But of course, we haven't really entered into at the beginning of the flu season yet. And of course, that will happen as we get into colder weather. Now, I think one of the risks for the euro is the state of the size, I should say, of the recovery fund. We know that this is a big political step forward for Europe. It does show that Europe can, or the European leaders, can come together. They can compromise. They can put something together. And that was a really big political step. But there is the possibility that if lockdowns are more protracted, are more extended, that this recovery fund could prove to be just a little bit small. And that could be a political hurdle, because I think from the Frugal Four's point of view, there isn't really any more room for compromise to make that fund any bigger. So perhaps we haven't heard the end of this story about the recovery fund just yet.
Yeah, that's interesting, and also puts the focus back on some of those factions within Europe that are looking to pull Europe apart. We saw the founding of the Italexit Party, of course. Do you think that that becomes a theme then if we see the funding limit being tested of this European Recovery Fund?
I don't think that we can really cast this aside, as the markets really have done over the last few months, since May, that the market's very, very optimistic about the euro right now. And I do fear that perhaps too much optimism is priced in. Now, not only did we have that new party in Italy, I think it was found on July the 23rd, just a little bit after the recovery fund, but opinion polls also suggest, particularly in Italy, that anti-EU sentiment is there. And if Brexit were to prove a success 5 years on, then actually we could have more people in Italy clamoring for something similar. Now, bear in mind that we are going to see rises in unemployment, for instance. We are going to see economic hardship. That often means that politically there are just pressures for something new, some changes, and that means that the euro's pressures could return at some point.
The euro's pressures could return. That's interesting, because I was just looking at some data suggests asset managers have never been more bullish about the euro. Jane, does that makes you nervous then for the path forward for the euro, whether it can continue this strength?
Yes, exactly. Now, I do say that the euro's fundamentals have improved, certainly, and the ECB's policies are part of that as well. But I do worry that the optimism has just gone a little bit too far. We do, of course, have considerable concerns about the economies. Germany exports to China could be another point of potential weakness if China growth does stall. So there are various different concerns around the eurozone, which over the last few months have been totally overlooked, and it just worries me that the optimism about the euro has perhaps become a little overextended.
Yeah, is a strong euro one of those worries, Jane? I was talking to Nick Nelson of UBS earlier on. He was saying a 10% appreciation in the euro versus the dollar, that produces a 6% hit to profits. And we have seen a 10% move since the lows for the euro in March against the dollar. But then I spoke to one analyst yesterday who suggested, look, the ECB is not going to worry about the strength of the euro unless it's at 130, and what we're flirting with 120 right now. So how concerned should we be from a corporate perspective, do you think, about that dollar weakness and euro strength?
Well, I would certainly say that the pace of the move has raised and will have raised a few eyebrows in Europe, whether or not it be with the corporates or whether or not with the policymakers at the ECB. No central bank or no Treasury department is comfortable with movements of this extent. It makes it very difficult for them to forecast and anticipate what or how prices are going to move over the next, say, 12 months or any time frame indeed. So the pace of the move will have made a lot of people uncomfortable. Now, certainly, if you look at various models of fair value, the euro certainly isn't that stretched, but in an environment where many economists are suggesting that inflation pressures could be quite weak, where it's going to be difficult for firms to pass on higher prices coming through the supply chain or wherever else, onto consumers because of pressures on wages and pressures on employment. Nobody really wants a stronger currency. In fact, in this sort of environment, a weaker currency would be more useful. So there will be some pressures for some firms, certainly, and policymakers, they won't particularly be welcoming of this move either.
Talking about recent currency strength, Jane, takes us on to the pound. The pound against the dollar, 132.44, giving up its short-lived spike on the CPI data we got at the top of the last hour. It was much higher than expected, though, wasn't it? That CPI number, pent-up demand seems to be part of the story. How do you expect that to drive into the pound? How do you expect the pound to trade this year?
Well, it was a surprise, I think.
Good morning, everybody. How are you today, guys? I'm placing a new order to sell short at €1 at 119.35.5. Order place to sell short 119.35.5. Let's see.
Most economists do think that inflation is more likely to trend lower, that we're more likely to have disinflation than, say, hyperinflation over the next couple of years. But those supply chain issues do cast a cloud over some of those expectations. Now, with the pound, I think it's not really going to be inflation. That's the big trigger. It's these Brexit talks. And last night, again, we saw these breaking down, at this time over truckers' rights, the EU saying that the UK is asking for just too much. But I think over the months ahead, if we don't get a deal, if we don't have some sort of compromise on the trade issue between the UK and the EU, sterling could be really quite vulnerable.
Yeah, much potential for volatility, it would seem. Jane, thanks very much. Stay with us. Jane Foley from Rabobank with us.
I opened new position for euro at 119.35.5, short position.
Fairly flat this hour. We'll discuss that next. This is Bloomberg. Welcome back to the European Market Open this Wednesday morning, 11 minutes into a trading session that is flat to negative. We're just down 0.1% on the FTSE 100, even flatter than that on some of the other major markets here in Europe. Let's get a Bloomberg Business Flash. Some of the top corporate stories that we're covering here on the Bloomberg terminal. Maersk has raised its full-year outlook. The world's largest container line says profit for 2020 will be between $6 and $7 billion, but the company's CEO, Soren Skou, says that doesn't include the possibility of a second phase of lockdowns. The company was able to stay open for business throughout the crisis, but warns uncertainties still remain. German utility giant RWE is planning to raise up to 2.1 billion euros in a share sale. The new stock represents 10% of its market value. Depending on the pricing, it could be the biggest spot offering of new shares in the region this year. RWE is hoping to use the money to expand its renewable energy operations. Amazon plans to make it harder for merchants to ship products themselves. It means that they'll be more likely to pay the company to handle the task for them. New shipping rules mean sellers will have to honor 1- and 2-day delivery pledges. If they can't, they risk losing a coveted Prime fast shipping badge. That is your Bloomberg Business Flash. Now, the dollar is holding at its lowest level in some 2 years after a 5-day losing streak.
Stop on profit for euro at 133.5.
with us. And Jane, I'm going to give you the impossible task of telling me the definitive driver of weak dollar right now, because every day I read new contributing factors. I mean, negative real yields, is that at the heart of it? Is it this push higher we've seen in inflation, very small by global standards or by historic standards, but still relative to March, a slight push higher in inflation and the low yield environment? Is that at the heart of it? What's the real driver?
You know what, I think there's various factors all coming together. Negative interest rates are certainly part of it. I mean, it is unusual perhaps in the US to have negative interest rates, but we have had it before. But I think this time, because nominal interest rates are so low, there is this perception that yields or interest rates could be negative for perhaps a more protracted period. But I think the whole the whole inflation argument is a really, really interesting one. I mean, already today, of course, we saw that stronger than expected UK CPI index. The economists are not of the view, particularly, that we are going to see a lot of inflation because, of course, we are expecting to see higher unemployment levels. We've got pressure on wages, etc. We don't think that producers are going to be in a position to push on higher prices. And also, of course, for decades now, we've seen real problems in the developed world to push wages higher. So that's the economist point of view. But of course, many people are taking a different stance. Look at gold price, for instance. That is linked to negative interest rates, negative real interest rates in the US, and also expectations that we could see asset price inflation push higher in the way that we did after the QE was initially used in the US during the global financial crisis. So a really broad debate about inflation over the next few years, and that certainly is part of the factors impacting the dollar. But a Democratic president and potentially another pressure on the US growth outlook, it tends to bring more regulation and higher taxes. So a big variety of reasons. But I think right now we have a lot of momentum behind this dollar weakness. Come September, I think we could have a correction for some of the losses that we've seen.
It's interesting, isn't it? Because taking all you've said there, Jane, and then asking the question whether the dollar is still the haven, it certainly was during March, and every time you raise doubts about the dollar as a haven, it proves to be one. Once again. So I'm mindful of that. But I was reading Stephen Roach's piece some months ago talking about a 35% drop in the dollar versus a basket of countries that the US trades with. That was his expectations, 35% drop. And he was talking about how the poor savings in the US and the current account problems would eventually undermine the dollar. They'd push up the yuan, push up the euro, and the dollar would fall. Is that something that in the end undermines the dollar as a haven, or no, do we not get there?
You know what, I don't think that we do get there. At least if we did get to a scenario like that, it could be several decades out. And the reason for that is that the US dollar is still the dominant currency of the global payment system. And although there have been attempts by perhaps China to try and alter this, even the EU have tried to put some momentum in place to try and alter this, it's going to take a very, very long time to change this. People need dollars. They need dollars to finance their debt. The amount of dollar-denominated debt issued by foreigners has been growing since the global financial crisis. And of course, dollars are the big currency for transactions. Now, that is really quite interesting. There's some research by the BIS, I think it was published in December, that suggests that the currency that invoices are issued in is a real significant factor between which currencies that the central banks have in their reserves. And that cannot change very, very quickly. So I think the dollar will remain a safe haven, irrespective of its current account and budget position, really for some time, for some decades. And again, this is a function of the intrinsic characteristics of the dollar, its use in transactions, its liquidity, more than the intrinsic qualities of the US economy.
Yeah, I remember being recently quite surprised at the number of Chinese businesses, or rather the scale of the use of the dollar in trade by Chinese businesses, regardless of the fact that the Chinese government, of course, wants to push the yuan as a trading currency. Let me ask you about what you foresee then for the dollar. So it would take decades for that kind of scenario to develop that I put to you there from Stephen Roach. But I've read interesting thought pieces also about how Americans do seem to be preparing for a weaker dollar, maybe just a slightly weaker one. But if you look at what Warren Buffett is doing with gold, or the rate at which Americans are now buying housing, some people were suggesting that this was all about preserving wealth. Do you see any of those signs, Jane?
Well, I think if you were worried about inflation, and of course many people are, then that would be the move to go. If you look in housing, that's a hedge against inflation. Gold is traditionally a hedge against inflation. And I think many people are concerned about the characteristics that we did see after the global financial crisis. We saw a lot of money being pushed into assets, intrinsic assets, not just housing, but also, of course, classic cars. We saw art, for instance. All of these assets really did push higher, and this of course related to very, very cheap money. And now the interest rates have turned negative, or real interest rates have turned negative, there is the possibility that we get another boost to these asset prices too. So again, given what we saw after the global financial crisis, this certainly is a risk.
Jane, thanks so much.
I'm moving down my stop and profit. It means up in profit, yeah, to 119.30.5. Okay. So if it's closed at this level, we'll have around we'll have £500 in profit.
Welcome back to the European market open. 22 minutes into Wednesday's session, down 0.25% on the Stoxx 600, but that's certainly not the whole picture. We've got travel and leisure stocks actually outperforming today. Some of the UK-listed airlines trading higher, and perhaps this is around the possibility of testing at airports. We're getting some lines coming through from the Health Secretary in the UK on that subject. We'll bring you more on the markets shortly. Oil prices have eased from a 5-month high after a report signalled US gasoline stocks are surging. It comes ahead of a meeting of OPEC and its allies to assess its supply agreement. Joining us now for more is Anne-Marie Hordern. Good morning, Anne-Marie. What is going to be on the agenda then for OPEC and friends?
Good morning, Anna. Well, I think it's very clear this morning that top of the agenda is going to be compensation, bringing those cheaters on board. And this really comes very clear from the kingdom. Saudi Arabia's King Salman has called Nigeria President Muhammadu Buhari this morning, and they discussed the importance of compliance. So the Saudis are making it very clear that they will not tolerate cheaters for very long. This has been the agenda really for Russia and Saudi Arabia since they were really bearing the burden of these cuts. And it's not just complying with the cuts that are, you have to do exactly right now for this month. They also want them to, in a way, atone for their past sins. So making up compensation cuts for the past ones that they have missed. For Nigeria, they are lobbying to count one of their oils as a condensate instead of a crude. That might help them bring into line. Iraq, for their part, they have been doing better in terms of compensation. They've implemented about 80%. So for the Iraqis, it's been probably the best we've ever seen. But as Halima Croft says, compensation may be just a bridge too far. This is 100% wise. This is a country that is still dealing with a very dire economic outlook. They are still dealing with the effects of war and sanctions. So for the Iraqis, it may be a bit harder, but it is clear that compensation and getting cheated in line is on top of the minds of the kingdom, as well as the likes for Moscow.
Yeah, so top of the agenda is going to be whether those who've not been playing.
Position closed on euro at 119.30.5. 500 pounds in profit.
We just heard from the IEA last week, and they dropped their second half outlook by 500,000 barrels due to the depressed air travel. Yesterday, of course, we saw what you mentioned earlier, Anna, that U.S. report of surging U.S. gasoline stockpiles. So motor fuel, that is surging. And Amrita Sen is saying they need to remain vigilant if they want to be able to have control on this market. At any point, you can have a demand pullback. So it's going to be a balancing act. These are shaky times in terms of the demand, and that is why we are seeing this maximum pressure campaign for every country to make sure they are complying at 100%.
Okay, Anne-Marie, thank you very much. Anne-Marie Hordern with the latest on the oil story. And we are a little bit weaker, as we've been saying, for oil prices. So the Brent price, $45 a barrel, down by 0.9%. WTI, 42.54, also down by a similar margin. Let's take a look at some of the stocks on the move today. RWE's in focus, the biggest loser on the stock 600 after the German utility giant priced its share sale at €32.55. It wants to invest in renewables, of course, so that announcement about the share sale came yesterday. Maersk in the shipping space climbing, that stock really climbing after the world's largest container liner raised its full-year outlook, gave quite a positive story to the markets, and the stock is up by 5.5%. Unibrew also in focus, the biggest gainer on the stock 600. This is a Danish brewing business. It's raised its forecast for the year, and you can see that that is having an impact on the company. Up next, Belarus sends troops to the EU border in a drastic escalation ahead of a leaders' summit today. What is the latest thinking on this move and the general approach to Belarus in Europe, in Brussels, in Frankfurt, in Berlin and in Paris? We'll get the details on that next. This is Bloomberg. Welcome back. This is the European Market Open. 30 minutes of trading under our belts, and European equity markets have been weaker, but not by much for the first half hour of the trading session. So down by 0.1% or so on these major markets. Actually, the DAX and the CAC just into positive territory. So things looking fairly flat this morning. Interesting sector breakdown we've got here. We've got basic resources, utilities, oil and gas at the bottom. I'm reading about how energy stocks are trading weaker as a result of some of the latest stockpile data ahead of the OPEC meeting, looking at slightly weaker energy prices and oil prices in particular this morning. To the upside, though, travel and leisure is interesting. Some of the UK travel and leisure stocks doing quite well, and we have had some news headlines overnight and this morning surrounding whether the UK government is going to be able to make testing at airports a factor in their policy, and that is having perhaps a bit of impact on some of these aviation stocks. We certainly see some of them outperforming today. We see the likes of Ryanair making very modest gains, but International Airlines Group, which is of course British Airways and Iberia, that stock up by 4%. So that's a quick look at where we are on the sectors then. A mixed picture for the sector breakdown for European stocks. Let's get a Bloomberg First Word News update. Here are some of the top stories we're covering this morning. A sign of compromise in the stimulus deadlock on Capitol Hill. House Speaker Nancy Pelosi says the Democrats may be willing to make cuts to their rescue package to seal a deal with Republicans. But she then wants to come back after the November election with more items on the agenda. A senior official tells us the White House sees the possibility of a pared-down package of around $500 billion. Canada has named Chrystia Freeland as its new finance minister. It gives one of Prime Minister Justin Trudeau's top aides the job of overseeing the nation's economic recovery. She's been one of Trudeau's go-to ministers for some of the government's main issues, including renegotiating the North American Free Trade Pact. Freeland is the first woman to hold this new position. The political crisis in Mali has escalated. The president has resigned after being detained by the military. In a broadcast on state television, he says he felt he had no choice but to comply. It comes after weeks of protests that allege corruption and nepotism within the government. Mali's neighbours have condemned the move, announcing sanctions. Hong Kong is clearing up after its most powerful storm so far this year. Typhoon Haigos disrupted business and travel and forced the cancellation of morning stock trading in Hong Kong. But it caused little damage. Hong Kong has now lowered its warning signal as Haigos is moving away from the city, and trading restarted in the afternoon session. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Back to geopolitics, the Belarusian president is facing his biggest challenge in his 26-year rule as strikes and protests continue against his leadership. Alexander Lukashenko has deployed the army to the country's borders with the EU, drastically raising the stakes ahead of a planned summit between the bloc's leaders. This as Russian leader Vladimir Putin discussed the crisis in separate calls with Chancellor Angela Merkel and President Emmanuel Macron. He told Merkel of the, quote, unacceptability of any attempts at external interference. Joining us now is Ian Wishart, our European politics reporter in Brussels. This has taken an unexpected turn, perhaps, with the positioning of these troops then, Ian. What will EU leaders hope to achieve from their meeting today? I think foreign ministers discussed this last week, didn't they?
Yes, the foreign ministers discussed this last week, where they decided basically to start the process for imposing sanctions. But I think leaders really realised that this was too serious to leave just to the foreign ministers, and they want to sort of show some symbolism that Europe doesn't go to sleep, doesn't go on holiday throughout August, and actually this is quite an important topic that needs their discussion. However, you know, they are in a tricky situation, the EU leaders, because they can't really do all that much. Their influence really is quite limited. So I think today they're going to talk a lot. They're going to come out with some very strong statements condemning the anti-democratic crackdown we've seen on the streets of Belarus. But really, there's not a lot more than that they can do at this stage.
There is a nice border with the EU from Belarus, isn't there? So this is very much on the doorstep for the EU, even if, as you suggest, there's little political influence for historic reasons that they can bring to bear, and hence the conversations with Vladimir Putin. What are the risks then for the EU here?
I mean, I think they think the risk is that they don't want to be seen to be interfering in a foreign democracy. And I think they're worried that if they make it look like they're asking the people of Belarus to choose between either Europe or Russia, then that's, you know, that's not going to go down very well. That will be seen as kind of like, you know, the Europeans plotting against Russia, and something that the Kremlin sees as its backyard. So they're really going to play this gently. They're really going to play it down. They're really going to try to somehow open a dialogue with the current regime, with the opposition, to see if there's any way that perhaps there could be some kind of peaceful transition to a new government. I think that's the way they're going to play it today.
And what about the sanctions story then, Ian? Is that something that may be seen as, or well, if they do sanctions, they'll be careful, as you suggest, of not going too far, not overstepping the mark?
Yeah, I mean, sanctions is the one weapon they have got, and you know, up until a few years ago, there were already sanctions on Belarus, and they lifted those a couple of years ago in order to try to create the environment where they could talk to the Belarusian leadership. Now, as you say, the foreign ministers have decided to put some sanctions back. I think what will be the topic of discussion over the next week or two will be how far to go. How much do they want to keep their powder dry and say, look, this is in our armory, we're not going to do it yet, we want to see what happens. But they know that ultimately they can sanction officials very close to the government in Belarus, and that will also send a signal to the Kremlin as well. And I think, you know, there's a three-way conversation going on here.
Yeah, Ian, thanks very much for bringing us the Brussels nuance. Ian Wishart, our European politics reporter in Brussels, thank you very much for the update. Up next on the programme, the Democratic Party officially announces Joe Biden's nomination as presidential candidate. We'll hear from the DNC event and deep dive into Biden's green policy next. This is Bloomberg.
If you want a president who defines the job as spending hours a day watching TV and zapping people on social media, he's your man. Denying, distracting, and demeaning works great if you're trying to entertain or inflame. But in a real crisis, it collapses like a house of cards.
Donald Trump inherited a growing economy and a more peaceful world. And like everything else he inherited, he bankrupted it. When this president goes overseas, it isn't a goodwill mission, it's a blooper reel. He breaks up with our allies and writes love letters to dictators. America deserves a president who is looked up to, not laughed at.
Joe Biden will be a president we will all be proud to salute. With Joe Biden in the White House, you will never doubt that he will stand with our friends and stand up to our adversaries, never the other way around.
President Bill Clinton there, alongside two former secretaries of state endorsing Joe Biden. This as Democrats officially nominated Biden as their candidate for president at the Democratic National Convention. Now let's home in on some of the specifics of his campaign. Joe Biden's Green Plan aims to spend $2 trillion to help the United States economy get out of the pandemic-era recession. It promises an overhaul of the American energy system that will put climate change at the heart. The ambitious plan sets a goal of a carbon-free electric grid by 2035. We've got a couple of voices lined up this morning to comment on climate matters. Let's get first to Bloomberg's Green reporter, Akshat Rathi, who's with us now. Akshat, good morning to you. So Biden's climate plan as a candidate is quite different from his plan during the primaries. So what's he been changing? I'm not entirely sure if Akshat can hear me, so we will leave that conversation there. We'll try and get back to him. As I said, lucky we have a couple of voices lined up to talk about the green agenda and the ESG agenda this morning, turning from those political climate plans to changes pledged by businesses. And today marks 1 year since the Business Roundtable's statement dumping its advocacy of shareholder primacy, which it had previously had, of course, in favour of stakeholder support, specifically with a focus on ESG. Let's bring into the conversation and discuss this Chuka Ramuna, Executive Director and Head of ESG at Edelman, the communications business, and also, of course, former UK Shadow Business Secretary. We've talked to him many times in that guise. Chuka, great to have you on the programme in your new role for a new conversation. Let me ask you then if anything has changed. So 1 year on since the Business Roundtable made these pledges about taking into account the views of a wider group of stakeholders rather than just shareholders, has anything really changed amongst the signatories to that?
Well, I think it has actually, and good to be back on your show, Anna. Good to be back on Bloomberg. I think there are two things to this. First of all, were they right in what they said, those 181 US CEOs who pledged to take into account stakeholders, not only shareholders? And let's remember, part of their rationale for this was that if you don't take into account the interests of shareholders, of stakeholders, it will ultimately negatively impact on shareholders. And if you look at what has happened in the last 12 months, you've had ESG funds outperforming the wider stock market during the COVID-19 sell-off. We've actually had more research come out in the last few months showing that the majority of sustainable funds have beaten traditional funds. And then we have seen greater and greater pools of capital chasing ESG investments, despite the challenges that COVID has posed. So already, we have had a massive increase in sustainable bond volumes. Social bond issuance has absolutely rocketed to more than double the total amount raised in 2019, already now in 2020. And there is strong evidence that corporates with a good ESG profile have proved much more resilient in the face of COVID. So on that front, all that data definitely vindicates what those Business Roundtable signatories said. And in terms of their own performance, there are a whole host of measures, whether it is paying sick pay where otherwise it wouldn't be payable, providing free PPE, investing millions to support communities. On that measure, you've seen, for example, 3 times more Business Roundtable signatories are 3 times more likely to give pay time off, for example, than the general average. And so on different measures, Just Capital have actually done a bit of research on this. They have actually put their money where their mouth is, but we've still got a long way to go. And the research that we've carried out through our trust barometer at Edelman shows that if companies don't, live true to these stakeholder values, actually the public and customers will punish you. They won't buy from you.
And Chuck, it's interesting. You mentioned some of the progress that has been made, and there is still a long way to go. And on that point, a couple of my Bloomberg Opinion colleagues wrote a piece recently that identified some of the members of this group who signed this pledge who don't pay a living wage. This is mostly US-based research, but who aren't paying a living wage. And that won't be true for all of these businesses, of course, but maybe it is then for some, according to this piece of research. Is closing the gap between CEO pay and the pay of the broader employee base, is that something that will take these businesses closer to these ESG goals?
I think CEO pay will continue to be a controversial issue. There's absolutely no doubt about that. I think the key will be the overall level of wages amongst the workforce in a business relative to revenue and profit. And so I think that's always going to be looked at going forward. And of course, during COVID, we've had a huge resurgence of interest in issues of equality, particularly following the tragic death of George Floyd. And again, the research that we've carried out through our trust barometer has shown that, 60%, more than 60% of Americans are saying that they will either make buying or boycotting buying decisions based partly on the record of a company on these kinds of issues of social justice. And so if you don't do these things and the public perceive, perhaps, take CEO pay, if that becomes an enormous controversy, then it's not just that it's not great for your reputation, but actually you will see citizen customers acting with their wallets and simply not buying products from you anymore. I mean, look, here in the UK, a good example of an ESG controversy that there has been Boohoo, which is, one of our fast fashion chains. Before they had this ESG controversy in the last 3 months, they were twice the size in market capitalization terms, and Marks and Spencer's, a big old British institution. After the ESG controversy surrounding the treatment of workers in its supply chain, it lost more than a third of its market capitalization. And there you could say, arguably, that was investors acting with their feet. And so increasingly, you're seeing these ESG issues that sometimes have been described as intangible and not necessarily purely financial, having a huge impact on the bottom line in your market capitalization.
And so is that influencing whether shareholders push back against this broadening of corporate interests? As companies try to take into account the interests of all of these stakeholders, are shareholders pushing back, or are they saying, no, actually, on a long-term view, our interests align with this broader definition of stakeholder interest?
I actually think it's more the latter than the former, because increasingly a company's ability to integrate environmental, social and governance factors into its decision-making is seen by investors as a proxy for prudent risk management. We do an investor trust survey in terms of what investors, money managers, portfolio managers are thinking, and that is the emerging consensus view. If you are not taking account of these issues properly, then you, in the end, the bottom line will be hit, shareholder value will be hit. So it's definitely much more the latter than the former. And I think we've seen a sea change, actually, Anna, coming out of this crisis, which has brought even more focus on ESG issues relative to when we came out of the global financial crash in 2008-9, where I think it's fair to say, for example, in the financial services sector, a lot of people just sought to go back to business as usual and pretend that a global financial crash, which had led to deficits rocketing and the broader public having to pay the price for that, they thought they could just pretend that that hadn't happened. I think coming out of this crisis, it's quite clear that business is much more sensitive to its role in society and how it is perceived by citizen customers, which is why, if you look here in the UK, corporates have been quite careful as to whether they take advantage of state support through this pandemic, because they know if they take advantage of state support and say 12 months down the line, there is a big compensation package announced for its CEO, or they want to do a big share buyback, or they wish to make big dividend payments. If they've taken state support, only 12 months beforehand, that's going to be extremely controversial.
Okay, Chukka, thanks very much. Thanks very much for joining us. Chukka Ramuna, head of ESG consultancy at Edelman and formerly Shadow Business Secretary in the UK. Thank you very much for bringing us your thoughts on this one-year anniversary then of that Business Roundtable event. Let's get back to the US and looking at the Democrats' climate plans, because this is something that the markets are thinking about a great deal. Joining us for more detail, Bloomberg's Green reporter, Akshat Rathi. Biden's climate plan then is different to what he was talking about in the past during the primaries, Akshat. What's changed?
It's a very smart move. Biden recognized that within the primaries, there was a large progressive arm. Many candidates were much more aggressive on climate. And when he became the presumptive nominee, he reached out to the progressive arm, he reached out to Bernie Sanders, and he created this committee to figure out what could be the compromises that he could make on his plan that would bring along and bridge this divide that has existed in the Democrats, because he will need the entire base if he is to put a strong showing against Trump. There's also the chance that some Republicans, perhaps those who are closer to the center, may change their mind and vote against Trump this time, and he's also playing to that base.
Biden is promising a carbon-free electric grid by 2035, Akshat. How realistic is that in the US?
It's really ambitious. There is no large economy that has set a carbon-free target for 2035 or sooner. And doing this is going to be a real challenge. But a recent report from the University of California at Berkeley showed that using today's technologies, the US could get to 90% carbon-free by 2035 without too many difficulties. It's really the last 10% which becomes really complicated. Today, that is met by natural gas power plants, and we will have to invent better technologies or integrate the technologies we have today much better to be able to cut the last 10%.
Akshat, thanks very much. Thanks very much for bringing us the story. Yeah, the stubborn last 10%, difficult to budge then. Thanks to Akshat Rathi from our Bloomberg Green team. Coming up on the programme, we'll bring you the stocks on the move this morning. This is Bloomberg. Welcome back to the European market open. Nearly an hour into the trading day, 55 minutes have gone by, and we haven't moved all that far on European equity markets, but we have bounced up a little. We're up now by 0.3%. Let's get into some of the individual movers. RWE is the biggest loser on the Stock 600 after the German utility giant priced its share sale at 32.55. It wants to invest in renewables in the context of our previous conversation around the green agenda. That is interesting. Maersk is climbing, the shipping business, of course, after the world's largest container line raised its full-year outlook, where they were able to reinstate the guidance they'd previously withdrawn, and that stock up by more than 5%. Unibrew, also interesting, the biggest gainer on the Stock 600, the Danish brewer raising its forecast for the year, and shares in Unibrew now up by 9.6%. Galapagos falling 25% after the FDA doesn't approve an arthritis drug. That's the Food and Drug Administration in the US, of course, that may also affect a partner on the drug, that is Gilead. So we'll keep an eye on that one. Let's check out some currency moves for you, because we've talked a lot about the weakness in the dollar over the last 5 days or so. The dollar's pretty flat right now. A little bit of upside bias to the pound and to the euro. So the pound trading around the 132 mark, the euro around 119. Inflation is part of the story here. We had some inflation numbers out from the UK earlier on this morning, which showed those had come in a little stronger than expected. We're soon to get inflation numbers for the Eurozone as well. So European equity markets on the front foot, up a few tenths of a percent this morning. Surveillance is next. This is Bloomberg.
The S&P and NASDAQ power to a record close. European stocks falter. On Capitol Hill, Nancy Pelosi hints the Democrats could compromise to seal a deal on more stimulus. Joe Biden becomes the official Democratic nominee for November's election. President Trump ramps up the anti-China rhetoric, saying he called off trade talks with Beijing. And easing on hold, Angela Merkel rules out further loosening on virus measures after Germany records its biggest spike in cases for nearly 4 months. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. This is what the markets are doing. Again, we're seeing a lot of, actually, European stocks moving on the downside or certainly trading sideways. And this is despite record highs that we saw on Wall Street. So this is what we're also looking at when it comes to gold. Always good to look at gold because it gives you a good sense of where there's appetite or not. Gold slipping back below $2,000 an ounce. We saw declines in RWE and other utilities outweighing gains in travel shares as the Stocks Europe 600 index actually gained. Now, coming up on Bloomberg Surveillance, Charles Lee, the chief executive of Hong Kong Exchanges and Clearing, joins us for his first interview after the company posted a record first half profit. That's in a couple of minutes. Now, ahead of that, let's get straight to the Bloomberg First Word News, and we start with Joe Biden. It's official. He's become the Democrats' nominee for president. It was confirmed at a virtual roll call during the party's remote convention. Well, the second night of the event saw a slate of speakers from former President Bill Clinton to Representative Alexandria Ocasio-Cortez. Biden himself will close out the event on Thursday night. President Donald Trump says he called off last weekend's trade talks with China. Now, it raises questions about the future of a deal between the world's two biggest economies. China is making many structural changes it promised as part of the Phase 1 agreement, but its purchases of U.S. goods is well below where they need to be to meet the target. And Belarus's President Alexander Lukashenko has put the army on alert, deploying it to the country's borders with the European Union. It's an escalation of tensions as he faces mass protests and the toughest challenge yet to his 26-year rule. It comes as the bloc holds a special summit to discuss the situation in Belarus, while European leaders may decide new sanctions are needed. Now, the political crisis in Mali has escalated. The president has resigned after being detained by the military. In a broadcast on state television, he says he felt he had no choice but to comply. It comes after weeks of protests that allege corruption and nepotism within the government. Mali's neighbors have condemned the move, announcing sanctions. So that's the First Word News, the global news 24 hours a day on air at Bloomberg. A quick take. Now, let's get you to the interview of the day. The interview on Hong Kong with a series of high-profile Chinese stock listings and a pickup in trading have seen Hong Kong Exchanges and Clearing posting a record profit. Investors have been flocking to the bourse this year, propelling its share price by more than 50%. Well, for more, Bloomberg's Yvonne Mann joins us from the Hong Kong Stock Exchange. Yvonne, over to you.
Francine, thank you. I'm pleased to be joined by Charles Lee, the Chief Executive of Hong Kong Exchange, to talk us through these record profits for the first half. Charles, thanks so much for joining us.
Great. This is really a happy day for us. We just announced record half-year earnings.
Yeah. Talk us through the IPO pipeline, though, because it's been strong. You had Alibaba last year, you had NetEase, JD, and now you're preparing for the likes of Ant Financial to come to Hong Kong as well.
That part of our life just continues. You have one big deal, another done. Just keep on going that and keep on trying.
Do you get a sense that this is more than just a 2019-2020 story, that this is going to go on, this deal pipeline for many years to come?
Well, there pipeline of companies coming from China, from the world, all over the place for the years to come. But obviously, in terms of large companies that are already listed in the United States, for example, to the extent they wanted to either come back or have another listing, then obviously that's a limited number. But still, even there, we're talking about hundreds of companies with market cap over, hundreds of billions of dollars. So still a lot of great opportunities for particularly those early, very successful, companies, unicorns that are listed in the U.S. But here, the record earning is much more about trading, about active, strong, enthusiastic participation by the market. Connect was particularly strong on both southbound and northbound, 46% up, big, really a big deal. And so I can't be happier and grateful because given what's going on around it, you can't ask for more.
Yeah, given what's going on, you've been talking about obviously the U.S. and China trade tensions. We've seen multiple fronts now. Just overnight, we heard the U.S. warning universities to divest Chinese stocks that are listed in the U.S. You have the threat of these companies being delisted in stock exchanges in New York. And then you have Hong Kong's special trading status has been withdrawn. How are you viewing this financial market rivalry now?
We are clearly witnessing, experiencing things that we have never ever done before, we have never ever seen before. So everybody's trying to make sense out of it. And I don't really think any pontification about exactly what the impact is going to be and how it's going to go. Everybody's going to have their own opinions. But in the end, I'm guided by fundamentally the wisdom of the market. I look at the market. Market is the place, the market is always the smartest. It's the place that can really digest, informed, and ultimately make a decision. Look at the market. Market cannot be better.
How do you secure your position, though, for Hong Kong Exchange and welcome these IPOs that have been listed in the U.S. coming back home, while also safeguarding yourself, though, from attacks from the U.S.?
Well, you know, anybody running a market, you just make sure that anybody who wants to participate in the market, you take the barriers down, you make sure you're the most efficiently run market, you allow everybody to intersect. In the end, market always have to deal with political situations, political upheavals, and political tension. This is not the time that we are very short of that, and but that also create opportunities and volatilities, and people actually wanted to trade, because in the end, everybody want us to succeed, because if the market succeeds, everybody else benefit, everybody else is going to win, and but sometimes you just have to keep your eyes open, and sometimes the storms comes, and to the extent you are able to make any changes to steer away from it, you try, but sometimes there are storms you can't, you just have to brace it.
President Trump said this week, Hong Kong will not be a successful exchange anymore. Hong Kong, and I quote, can never succeed under Chinese control, and its markets will, I quote, go to hell. What do you say to comments like that?
I don't really know, is that really what he said? But, you know, who knows?
Yeah, it is.
And misconstrued, but, you know, I think everybody is going to benefit if we do well. I don't know why anybody would wish us not to do well. You know, when my friends Andina is doing well in NASDAQ, I call her and congratulate her. And when my friends Jeff is doing well in IZ, I call him and congratulate him. And they all both wish me well. And because when we win, when the market wins, everybody wins. We are a global market. Mm-hmm. U.S. funds managers are here. U.S. investors are here. U.S. companies are here. And I don't know why anybody would wish us to fail.
Obviously, locally, we're dealing with a lot of political turmoil as well with this national security legislation that has come into effect for 2 months now. Mm-hmm. You've set your views about how long-term it's not going to be negative for Hong Kong as a financial hub. I'm just wondering, what if there is a conflict between this law and your listing rules? How can a Hong Kong exchange hold the line and preserve the credibility of the financial system here?
Well, we deal with conflict all the time. We deal with conflict between our rules and Chinese rules. We deal with our rules with the SFC rules. We deal with the differences in conflict between our rules and the U.S. rules. And this is just a fact of life. We deal with it. And in the end, you know, you have national law, and you have local law, and you have your own regulatory rules, and you have our listing rules. Our listing rules, among all the laws and regulations, are, you know, in that order. But in the end, most of our market-driven rules do not really get into conflict with big national laws. Generally speaking, we are a very narrowly focused market that deal with market behavior, with conduct, with how to run an efficient and fair and open market. And those rules are rarely in conflict with any of the, you know, the big political considerations that people typically somehow imagine a conflict of.
I mentioned about the national security law. In terms of the impact on financial markets, what do you see as the biggest impact domestically and internationally?
Well, I think everybody has a national security law. Everybody talking about national security law, even all the discussions about TikTok, WeChat, and that. So many things are now being under the overall umbrella of national security law. I don't really think the national security law here is in any way fundamentally different from when the U.S. government is talking about the national security law, when it comes to its capital market, when it's come to, all these big technology companies. So it's a fact of life. It's something that we all need to deal with. And, when you operating a market, you operate within the constraints and the structures of that, jurisdiction, whichever one of the big ones will have a very significant national security law, because the world is now developing to this stage where that's just a fact of life.
I want to talk a little bit more about the business, obviously, with your plans for MSCI, China A shares, those futures contracts. That's been pending approval for more than a year now. Why the holdup? Why do you think Beijing has been reluctant to approve this?
I think there is a lot of desire. There's a lot of willingness to really develop offshore hedging tools, for international investors going to the north. But they also wanted to make sure that that effort and the domestic market are properly aligned and coordinated. I personally think, it's ultimately will get resolved. But sometimes you also wanted to make sure that the instrument that you're able to do, that you're able to launch, is going to be reflective of what you really wanted to do, is going to be representative of the market. So we continue to discuss, because not only is the weather, but it's also what are the kind of products we are able to come up with that is the best useful and the effective tools for Northbound investors to hedge that risk.
Of course, a lot of questions about what's your next step after you leave Hong Kong Exchange next year. There's been a lot of questions thrown at you. I'm just wondering, would you be interested in politics, say maybe even run for chief executive?
Well, right now, my term is not ending until next October, or earlier if we have a new successor that is being recruited and to be able to take over. So until then, I'm still running the exchange. I'm still 100% responsible and active in that job.
You've talked about, though, if the stock hit more than $300, you would start coming up with a plan. Is it more towards politics or business? What do you think?
Well, I take guidance from the mighty forces out there.
Charles, we're going to leave it there. But thank you, Charles Lee, Chief Executive of Hong Kong Exchange. Fran, I'm going to throw it back to you.
Yvonne, thank you so much. We'll have plenty more of Hong Kong. Great interview there with Charles Lee of the Hong Kong Exchanges and Clearing, speaking to our very own Yvonne Mann. Now, coming up, it's tech again. Many global stock markets remain way below their peaks, but the U.S. S&P hits a record boosted by technology shares. We'll discuss that next, and this is Bloomberg.
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get on to markets. U.S. stocks finally hit a record propelled by tech companies and better than expected housing data. Now the fresh highs comes also as House Speaker Nancy Pelosi indicates Democrats could cut their stimulus proposal to seal a deal with Republicans. Now investors also shrugging off trade tensions as President Donald Trump confirms he called off last weekend's talks with Beijing. It raises questions about the future of a trade deal with China. Well, we're delighted now to be joined by Peter Gonnery. He is head of equity strategy at Saxo Bank. Peter, thank you so much for joining us. First of all, what are the markets pricing in? What are the markets not pricing in? Or do they look a bit frothy, or do you think they can go higher from now?
Well, I think with a forward free cash flow yield of around 4% in the MSCI world, I don't think equities is particularly expensive on a relative basis against the opportunity set that are presented in bonds. I know we're at an all-time high, but I mean, quantitatively, historically speaking, a new all-time high is definitely not a reason just to sell just off that technicality alone. But the world is pricing in a very low interest rate environment for the coming years. Potentially, we'll maybe get some clues about yield curve control coming at the KC Fed symposium in the next that will come in the next 8 days. That's the how to navigate the decade ahead. And if we get yield curve control and we settle into this very low interest rate environment, I think the trade that will be strengthening even further, which has taken place basically since the COVID-19 pandemic started, is what we call long duration assets. So that's real estate, it's technology stocks, it's gold, it's long-term bonds. That's basically a synchronized trade there. It obviously increases the risk as portfolios are rotating towards these long duration assets that are propped up in market value terms by these low interest rates. It increases the risk to inflation and a rate jump. So I would basically argue that this incredible rally we have basically seen since the financial crisis in 2008, so the rally that started in early 2009, I think that will come to an end when we get inflation. And I think that is also the main target of the Fed and other central banks, is to engineer inflation. But I think there's also a recognition that it's not in particular only a monetary phenomenon. The fiscal has to play its role, and I think that's probably why we will see yield curve control in the U.S. In the coming years.
But Peter, are we going to see runaway inflation? I mean, this is the gazillion-dollar question that everybody really wants to know. If we do see runaway inflation, where do we see it first, and is that your base case?
It's a very good question. I don't pretend to be an expert on inflation. I actually think that inflation is one of the biggest puzzles of modern economics. I don't really think we really understand what causes inflation. It's very difficult to forecast, especially longer term. It's also still not exactly clear why it happened in the 1970s. I would suspect that if we get a massive fiscal impulse driven by easy monetary policy, I think we have a recipe, but how it will impact the economy and where, I think it's a good question. But I do think that the current policy will be in place until inflation one day arrives. It's also much easier to deal with our debt mountain if that arrives. But then also, so inflation is one risk for equities. Another risk, which is very, very long-term, is the whole question about globalization and the U.S.-China tensions and to what extent it drives a reconfiguration of global supply chain. Keep in mind, since the early 1980s, we have had a very, very, very long upward trend in expanding profit margins driven by lower wage pressure and lower input costs to companies by outsourcing to Asia their production. So that's obviously also a key risk here for equities. But I think we have seen very tentative signs in both Europe and the U.S. that the deflationary pressure eased somewhat in July, and we might be turning a corner on inflation. UK also showed that this morning. So maybe July was the turning point on inflation. Yeah. I will say, though, a very quick comment. I think it's very important to understand that when we talk about inflation, we always look at an aggregate price level. But in fact, every single group in society has its own inflation basket. And some parts of the economy actually have a very high inflation. I would actually argue that the millennial generation with rents and education actually experiencing a very high inflation rate right now.
Peter, thank you so much. Peter Gunnery there from Saxo Bank stays with us. We'll talk about gold next. Now, also coming up right here on Bloomberg Surveillance, well, today's Fed Minutes yield nuggets for gold bulls. We'll discuss bullion and its phenomenal rise next. This is Bloomberg.
Joe Biden wants to build an economy far better suited to our changing world. Better for young people. Better for families working and raising their kids. Better for people who lost jobs and need new ones. Better for farmers tired of being collateral damage and traders. Better for workers caring for the sick, elderly, and people with disabilities.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, let's get back to some of your market perspective. Gold trading near 2,000 an ounce as investors await the release of Fed minutes later today. U.S. stocks have benefited from some risk-on sentiment, but bullion has also been getting a boost from renewed tensions between Washington and Beijing. Well, let's get back to Peter Gunnery from Saxo Bank. Peter, I know you mentioned gold, but how much of an upside can we have from here?
I think the upside could be considerable if we get yield curve control. I think gold will play a fundamental role in portfolios going forward, but as you know, central banks are clearly debating their currencies to engineer inflation longer term. And I think also Warren Buffett's latest move by allocating 0.5% of the portfolio to bury gold, I think it's evidence of very informed investors in this world are rotating towards gold as a key component in portfolios. So it's very interesting, and we also recommend our clients to have exposure to gold and gold miners.
What about, Peter, European equities? Do they create more of an opportunity than U.S. ones?
It's a very good question. European equities is very cheap relative to U.S. equities. We really want to be more positive on Europe. The big problem with Europe is that a large part of all the companies in the stocks 600 index have very bad earnings predictability relative to U.S. and it has a lower share of technology stocks. So and it has a very high share of financial companies. So that's the reason why I think in the current environment that foreign investors will still be preferring U.S. equities over European equities, but there is definitely a valuation case to be made for European equities. But I think in Europe you should be very selective in your stock picking and industries and sectors.
Peter, thank you so much for joining us today. Peter Gardner, their head of equity strategy at Saxo Bank. Now, coming up, the Democrats confirm Joe Biden as their presidential nominee. We'll have everything you need to know as U.S. election season moves a gear up. That's coming up shortly, and this is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
New order placed for euro short 119.365. Okay. Position opened, short position at 119.365 on euro.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, a lot to talk about, so let's start straight with the Bloomberg First Word News. And we start in the U.S., a sign of compromise in the stimulus deadlock on Capitol Hill. House Speaker Nancy Pelosi says the Democrats may be willing to make cuts to the rescue package to seal a deal with Republicans. But she'd then want to come back after the November election with more items on the agenda. A senior official tells us the White House sees a possibility of a pared-down package package of around $500 billion. Now, the U.S. is suspending changes to the mail service. That's after concerns over the slow delivery of ballots ahead of the November election. Democrats have accused President Donald Trump of hampering mail-in votes, and the Postmaster General says he's shelving the changes to avoid even the appearance of any impact on the election. Canada has named Chrystia Freeland as its new finance minister. It gives one of Prime Minister Justin Trudeau's top aides the job of overseeing the nation's economic recovery. She's been one of Trudeau's go-to ministers for some of the government's main issues, including renegotiating the North American Free Trade Pact. Freeland is the first woman to actually hold the post. And that's your Bloomberg First Word News. Now, Joe Biden, as we were just saying, is officially the Democratic nominee taking on President Donald Trump this November. It was confirmed at the party's virtual convention overnight. Now, the traditional roll call was restyled in the time of COVID-19 as a video tour across the U.S.
Want a president who defines the job as spending hours a day watching TV and zapping people on social media? He's your man. Denying, distracting, and demeaning works great if you're trying to entertain or inflame. But in a real crisis, it collapses like a house of cards.
Donald Trump inherited a growing economy and a more peaceful world. And like everything else he inherited, he bankrupted it. When this president goes overseas, it isn't a goodwill mission, it's a blooper reel. He breaks up with our allies and writes love letters to dictators. America deserves a president who is looked up to, not laughed at.
Joe Biden will be a president we will all be proud to salute. With Joe Biden in the White House, you will never doubt that he will stand with our friends and stand up to our adversaries, never the other way around.
Well, joining us to discuss all of this is Bloomberg's Kathleen Hunter. So, Kathleen, it seems that the Democrats and Joe Biden campaign wants to make this more about a referendum on President Trump rather than about them.
I think that's absolutely true. You know, elections where the incumbent president is on the ballot, to some extent, are always a referendum on the sitting president. But I think that's even more true this year because Trump is so polarizing, and also because the COVID-19 crisis has really put the questions about his presidency into stark relief for a lot of people. And so I think that's going to be even more true this year than it typically is.
So how has President Trump and his team been working to counter the Democrats' message?
Well, I think in several ways. You know, we saw the president in Arizona yesterday, for example, at the southern border, talking about Joe Biden and criticizing, what he perceives as Joe Biden's immigration policy to be. We know that immigration and getting tough on immigration has been an issue that Trump campaigned on very hard going back to 2016 when he talked about the border wall that Mexico was going to pay for. I think that, he's going back to that playbook this year and hoping that that energizes his voting base and gets them to the polls on election day, and especially in key states like Arizona that could end up being battlegrounds and being decisive when it comes to the overall win.
Kathleen, can we expect a stimulus deal anytime soon?
Well, it's been really, really hard for them to make any progress in negotiations, but there have been some promising signs over the last couple of days. Nancy Pelosi is calling the House back into session. She's broken out this part that pertains specifically to the Postal Service, and there are some indications that that could begin to, grease things and get things moving when it comes to the broader package. Republicans are talking about a slimmed-down version of their original proposal. So there are some promising signs, but the two sides are still very, very far apart, so it might be a very heavy lift going forward.
Kathleen, thanks so much. Bloomberg's Kathleen Hunter there, who follows U.S. politics. Now, coming up as we head towards autumn, should investors prepare for higher volatility? Well, that's a warning from the chief executive of Unigestion. We'll speak to Fiona Frick next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, let's get onto the markets and let's see what we could be expecting from volatility. We talk a lot about volatility, and U.S. stocks closed at a record yesterday, driven by tech and better than expected housing data. Now, as we head towards autumn, though, our next guest warns investors should prepare for higher volatility. She says she's temporarily cutting her positive tilt towards growth assets. I'm delighted to be joined by Fiona Frick, Chief Executive Officer of Unigestion. So, Fiona, good morning to you. How do you see this panning out?
So we believe that the rally that in the last 4 months has had a very strong momentum, and we think that a pause would be quite helpful. We believe that the sentiment on investors is turning a bit, and that valuation of equity are becoming quite expensive on the short term in comparison to historical data, historical PE, while it remains still quite interesting compared to bond yields. So we have a positive view on equity on the long term, but we think that we're going to have a pause in the next months with much more volatility, taking into account that there are some uncertainties around COVID, around the stimulus US pack, around China and US. So more volatility to come.
How much more volatility, Fiona? How do you protect yourself against volatility? I mean, do you just buy VIX, or do you do something else with the portfolio?
No, what we try to do is construct a portfolio which has some convexity, meaning that we buy options out of the money to protect on the downside. Our scenario is still positive for equity on the long term. So if market would go down 5-10%, which could be very easily, which could happen very easily, we would profit to buy again some equities. But in the meantime, we construct some protection with options.
Where do you see the biggest upside, Fiona? When you look at equities, are you positive on European equities compared to US ones, or is it more complicated than that?
There's a difference between the European and the US index in terms of sector allocation. So the US is much more geared toward technology, and the Europe is more geared toward old economies and old sectors such as bank, etc., etc. So I would say I wouldn't necessarily beat against US in terms of Europe. What I found interesting is that the growth of the market in the last 4 months has been very concentrated on a few names. And if you look at the performance of the S&P, except the 5 names, we are still at something like -7, while today the S&P is more on a positive territory thanks to the 5 names. So there is breadth in equity to go up in a perhaps more deconcentrated way.
Is there danger that central banks turn hawkish in the medium term and takes the market by surprise?
We don't think so. And the Fed meeting in July showed that, in fact, they intend to stay there for long. And the rhetoric they used was very dovish. So we believe that, in fact, they'll stay. They changed their role, I would say. In the past, they were more about reacting to the market. Now they are impacting the market. And the rhetoric is very clear that they're going to be there to stay. And they'll be even happy if there is a bit of inflation.
But are you worried, when you look at the main risks out there, Fiona, and if there's one thing you have to get right, I guess it's the fact that we don't have rampant inflation suddenly getting out of control, because that would reprice, frankly, all asset classes. Is that your biggest worry, even if you think it's unlikely, or is it trade concerns? Is it politics in the US? If you look at your 2 to 3 biggest concerns, what are they?
So my two biggest concerns, obviously, one is the macroeconomic environment. Obviously, we see a V-shape, but if there is a second wave of COVID and this is not well managed, this scenario could change. The second is the rhetoric of the central banks, because the market has been very correlated to what central banks and fiscal and government have been doing. So if the rhetorics change, if the stimulus package doesn't go out as it's expected, this could have an impact on the market, because the sentiment of the market is becoming more volatile, I would say. We follow something we call a newscaster, which tries to take out the sentiment of the press about what investors are saying of the market. And we see that in these last 2-3 days, the sentiment is becoming more negative.
a negative on infections, even if we have a resurgence of infections before we get a vaccine. How do you model that, and what kind of impact does it have on equities?
So we believe that for the moment, if you look at economical data, they are quite on the upside. And is it the housing market or some Japan's trade stats that came out today? They are still positive. If you look at earnings, I think 80% of the S&P 500 company beat their estimates. So I think this is quite good. What we see is more how investors are talking about the market. How do they see equity market reacting in the future? And because there is more uncertainty of this second wave, we could imagine very easily investors taking profit. So it's more about market sentiment, which is less positive, rather than the macroeconomic scenario, which we believe for the moment the data are quite good, and we believe in a V-shaped recovery.
A V-shaped recovery for the whole world, or are there parts of the world that will deal with it better? And is there a direct correlation with how they handled COVID-19 and opportunities in the market?
I think obviously how we handle the COVID-19 is quite important, but what is more important than that is that the COVID-19 is an exogenous shock that could have an impact, recession, if the central bank and the government wouldn't have acted. It's the first time that we see fiscal policy and monetary policy moving together in most of the countries. The first time that we see a sort of European Union agreeing to have common debt. So that we've been going a long way. If you look at central banks, what they've put on the table is twice what has been put on the table in 2008. So I would say that there is quite a synchronized effort compared to 2008 around the world. Would it be in Asia? Would it be in Europe? Would it be in the US? And also, it's the first time that we see fiscal and monetary policy in the main developed country going together, which is also a very positive signal. So we believe that central bank and fiscal policy will be there to cushion whatever impact the COVID can have on the short term.
So until when, Fiona, when you look at equity highs that we saw in a lot of U.S. markets, especially technology stocks, what will it take for that to correct? Is it just a trend that was meant to take 4 or 5 years, maybe? The move to more technology, possibly the move from working from home and all these virtual conferences, and is that just accelerated? So does that support, fundamentally a conviction in some of the tech stocks, or are you worried about valuation?
We're worried from some of the valuation. If you look at the valuation of the S&P 500, I think the valuation is around 22 times PE. If you look at the valuation of the 5 stocks, I think it's 10 points higher, so it's around 30 PE, 30 times PE. And if you look at the valuation of the others, 495 stocks, we're around 20 times PE. So what is interesting is that depending where you look at the market, some part can look expensive and some part can look less expensive. What we hope for is that if global growth continues to be seen in the numbers, there will be a rotation a bit about these expensive stocks, although they have great future perspective. They are quite expensive, and therefore a lot is priced already in it. So we would expect a rotation from these stocks to the other part of the market, which have still been lagging since the beginning of the year.
Fiona, final question on gold. What do you do with gold?
Gold has become a substitute for bonds. And it's a perfect asset that plays 2 roles. Because before, gold was not so interesting because you had to pay for the storage or whatsoever. So you would rather prefer to have government bond. But today, even US government bond has negative real yield. So in fact, gold serves 2 purposes in a portfolio today. It's a defensive asset, which can protect in a downturn. And second, it's an inflation an asset that can protect to inflation. So yes, we tend to believe that it's interesting to have gold in the portfolio.
Thank you so much, Fiona Frick, there, Chief Executive Officer of Unigestion. Coming up, we'll have plenty more on the virus. Coming up, we'll have a full roundup of what we also heard from the German Chancellor, Angela Merkel, as the country records its biggest spike in coronavirus cases for nearly 4 months. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. So let's get straight to the Bloomberg Business Flash, because there's a lot to talk about when it comes to corporate news. But let's start with the U.S. State Department asking colleges and universities to divest from Chinese holdings. It's warning them that tighter regulations could see some companies delist entirely. Now, according to Bloomberg investigation, college endowments represent billions of dollars of investments in Chinese firms. Amazon plans to make it harder for merchants to ship products themselves. It means they'll be more likely to pay the company to handle the task for them, while new shipping rules means that sellers will have to honor 1- and 2-day delivery pledges. If they can't, they risk losing a coveted Prime fast shipping badge. Germany utility giant RWE is planning to raise up to 2.1 billion euros in a share sale. Well, the new stock represents 10% of its market value, but shares are falling this morning as the pricing came in at nearly 5% discount to yesterday's close. Well, RWE is hoping to use the money to expand its renewable energy operations. And Goldman Sachs has signed a deal with Malaysia to finalize its 1MDB settlement worth $3.9 billion. The U.S. bank announced an agreement in principle in July, but it is now confirmed the pact doesn't resolve the probe by the U.S. Justice Department. 1MDB is a Malaysian state fund at the center of global investigations into corruption and money laundering. And finally, Maersk has raised its full-year outlook. The world's largest container liner says profit for 2020 will be between $6 and $7 billion. The company's CEO, Sorosoku, says that doesn't include the possibility of a second phase of lockdowns. The company was able to stay open for business throughout the crisis, but warns uncertainty still remains. And that's Bloomberg Business Flash. Now, on to other things here in Europe, and the number of cases are rising in Germany. Anthony Fauci, the top U.S. infectious disease specialist, says even when a vaccine becomes widely available, it will take time to get back to normal. He says the U.S. shouldn't abandon public health measures immediately. Well, Fauci spoke with Bloomberg's Quick Takes, Madison Mills.
It's going to take a while to build up a cumulative amount of immunity, either induced by the vaccine or by natural infection, to get to the point where you really have a veil of protection or an umbrella of protection over the community. That's not going to happen in the first couple of months of availability of vaccine. So we will not be able, I hope we don't, we should not abandon public health measures even when we do get a vaccine.
Well, that was Anthony Fauci speaking with Bloomberg Quick Take. Now let's get more with our Danny Berger. So, Danny, what was Fauci's assessment of the current state of the coronavirus outbreak in the U.S.?
Fauci voiced a lot of concern, Francine, over, he said, what was a worrying baseline rate of community spread of the virus. He pointed to a curve whose projection is still upward. Now, what he prescribed to help bring this back down is what he says the U.S. needs a uniform approach. That means more consistency in things like mask wearing, as well as social distancing. He sees it as too disjointed at this moment to make sure that these virus case counts come down. But look, Fauci is a man who's acutely aware of the political climate in the U.S. He's been thrust into it, really. So he didn't go as far to say that there should be a federal mandate for things like wearing a mask. Not that he doesn't think there should be one. He specifically did say that it would make sense. But he says getting a federal mandate passed on something like that would be impossible. So for that reason, he's not recommending it. Interestingly, though, this is really his main point, that you need to have these uniform approaches because it could prevent lockdowns. For example, he says that the case rises in the South, you wouldn't necessarily need to lock down those economies if you had things like hygiene and social distancing, that it's not mutually exclusive between restrictions and normal life. You can have both of them. In fact, the measures allow for these. Now, finally, Fauci did weigh in on the current mail-in voting comments that we've been hearing about the post office. Now, he didn't want to wade into politics, but did say that people really should be able to vote in person and by mail, Francine.
Danny, European leaders also voiced concern on recent uptake in virus counts. What did Angela Merkel say about that?
Right, so Angela Merkel speaking for the first time since virus cases were rising in Germany, saying that we should not be expecting any easing of restrictions in Germany, that the virus needs to get under control. We have seen cases in the region reach their highest since about April. And she said that, look, this needs to be brought under control. Germany already requiring people traveling from infected areas to quarantine when they get back or produce negative test results. She also said that fines might need to be levied against people who are flouting the hygiene and social distancing rules. Overall, her message, mobility and contact, that's what's causing these virus cases to rise. So Germany really needs to be vigilant that the virus is still here, even if it's not visible.
All right, thank you so much. Danny Berger there with the very latest on the virus after that great interview by Quick Take of Anthony Fauci. Now let's take a look at some of the other events we're watching today. 10 o'clock this morning, London time, we'll get the final CPI reading for the euro area. 11 a.m., European leaders will meet via video conference to discuss sanctions on Belarus. OPEC Plus ministers are also meeting online at 3 p.m. to review strategies for compliance when it comes to oil supplies. And later today, the focus shifts to the U.S., where the National Economic Club, or Economist, I'm getting muddled, club will host a conversation with Richmond Fed President Thomas Barkin on the economic outlook. In the meantime, European stocks are turning higher. U.S. futures also. Investors signaling continuing optimism in the post-pandemic rally after shares in the U.S. hit an all-time high. We also have gold slipping back below $2,000 an ounce. Well, Bloomberg surveillance continues in the next hour. Tom Keene joins me out of New York. We'll be speaking to Martin Sorrell of S4 Capital. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
The S&P and NASDAQ power to a record close. Lackluster session in Europe. On Capitol Hill, Nancy Pelosi hints the Democrats could compromise to seal a deal on more stimulus. Joe Biden becomes the official Democratic nominee for November's election. President Trump ramps up his anti-China rhetoric, saying he called off trade talks with Beijing. And easing on hold, Angela Merkel rules out further loosening of virus measures after Germany records its biggest spike in cases for nearly 4 months. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacroix in London, still working from home. Tom Keene in New York. Tom, it's an interesting day because we talk about Fed, we talk about policy, we'll look at inflation, and I think there are figures out of the Eurozone coming up shortly.
Also, the markets are talking as well. You got the S&P 500 out to record highs, back to the Valentine's Day. You remember Valentine's Day, Francine, and it was a different time and place. Seriously, folks, pre-pandemic for so many people, and the S&P 500 really getting back there to the record highs. But what I really focus on, Francine, is 1 day, 2 days, and now Wednesday, we are giving up that yield surge of last week, and that is a profound thing for global Wall Street.
Yeah, I'll never forget Valentine's Day 2020, Tom, because I think it's the last time I traveled pre-lockdown, so it's kind of like a milestone that you remember.
Ages away.
We'll have plenty more, of course, on those yields. Yeah, it feels years away. Let's get now straight to the Bloomberg First Word News in New York City. Here's Karina Mitchell. Hi, Karina.
Fran, good morning. Democrats have made it official. They've nominated Joe Biden to take on President Trump in November. Biden received the more than 2,300 delegates needed in a virtual roll call that was a video tour across the nation. Past Democratic stars like Bill Clinton and future ones like Alexandria Ocasio-Cortez made short appearances. Meanwhile, the Trump administration sees a path to a pared-down $500 billion stimulus deal. Bloomberg's learned the package would eliminate the biggest areas of disagreement between Republicans and Democrats. It would include financial help for the Postal Service, aid to schools, and money for businesses to keep their workers employed. House Speaker Nancy Pelosi suggested Democrats might also agree to a smaller deal. And President Trump is raising questions about the future of that trade deal with China. The president says that he called off last weekend's talks with Beijing. He said he doesn't want to talk to China right now. The president called China's handling of the coronavirus, quote, unthinkable. And the coronavirus outbreaks in Florida and California are showing signs of easing. In California, the number of new cases was less than 60% of the 14-day average. Hospitalizations rose slightly, but are now down almost 30% from a peak in July. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thanks so much. Greatly appreciated. Equities, bonds, currencies, commodities. Let's go to the equity market right now. What's interesting is the VIX really didn't move yesterday on the SPX, moved 21.64 on the VIX. Yeah, futures up a little bit today. I'm going to call it fractional. Dow futures up 24. NASDAQ on a percentage basis still leading. We've really had a relative resurgence in tech stocks off of what we've seen from small cap over the last number of weeks, that back and forth between the two groups. There's a key statistic for me, negative 1.0536. We go to 4 digits on Bloomberg Surveillance, and that's the real yield. That's the nominal yield less inflation expectations, and you get a big fat negative real yield. That is coming down to an ever greater negative yield. We're not through to record negative yield, but nevertheless, that's been a 3-day reversal. Dollar not playing today. Francine?
I feel like it's a fancy data check for Wednesday, Tom. I feel spoiled. My data check is more simple. European stocks trading higher, U.S. futures as well. Investors now seem to continue, signaling optimism in the post-pandemic rally after shares in the U.S. hit an all-time high on Wall Street and gold slipped back to $2,000 an ounce. Again, it's interesting because treasuries are rising before the Fed releases its minutes. It may give us clues about inflation targeting. Speaking about inflation, Euro area July consumer prices down 0.4%, a touch below estimates. Core prices actually pretty much in line with what we were expecting year on year at 1.2%. Now, to talk about inflation, to talk about some of their positioning, we're delighted to be joined by Mark Dowding. He's Blue Bay Asset Management Chief Investment Officer. Mark, thank you so much for joining Bloomberg Surveillance. What do you see right now in European yields? Where do you want to be in?
Well, in many respects, it's a quiet summer. We're seeing markets in pretty benign fashion and risk assets climbing a wall of worry. As you said, we've pushed to new highs in stock markets. We're seeing credit spreads grinding tighter, and for the time being, you seem to want to own the assets that the central banks continue to buy. So owning bonds in the European periphery, owning investment-grade credit is areas that you want to be positioned. But there is a sense that we have that maybe some of the best of the rally is now behind us. We've seen several very strong months, and frankly, we've seen a period where economic data has been getting better. The news flow, generally speaking, has been a constructive one. Going forward from here, we're wondering whether the bounce may start to peter out to a degree.
But there are fundamental shifts, Mark, in, Tom and I are basically drowning in news every day. And the market, as you say, is taking a fairly simple view of what's going on and kind of steady as they go because of what the Fed and other central banks are doing. Is there a worry that they miss some of the fundamental shifts, for example, in trade relations or how they model a Biden administration?
Yes, well, I think at the moment what we've seen over the course of the last few weeks is there have been a number of tail risks, whether it's to do with the US fiscal package, whether it's to do with the virus itself, or trade talks, for example, sort of tail risks that had the potential to disrupt markets, but none of them have really materialized or metastasized in a really sort of nasty way to really lead to a bigger market correction. And so for the time being, markets seem to be still trading sort of in a pretty benign fashion. If anything, it was kind of interesting, and you've been highlighting this, how actually in the course of the last few days, it almost seemed like a bigger threat to the rally in risk assets could actually be coming more from a rise in long-dated government bond yields. And that was linked in part to some concern that maybe inflation sort of numbers were starting to build. But intrinsically, we think it's a bit too early to get concerned about that. We're still in an era of yield curve control. And so although sort of good news leading to higher yields could actually be the thing that ultimately derails this rally, for the time being, it is difficult to really project a really substantive move in yields at this particular point being a sufficient catalyst.
Mark, good morning. Tom Keene in New York. Alice Gledhill at Bloomberg writes up Blue Bay Asset Management on these hybrid securities, COCOs, in the idea of traipsing through the bank stocks by using COCOs. Explain that strategy that Blue Bay was featured on.
Yeah, so here, one of the parts of the credit market that we've really liked over the course of the last couple of years and continue to like a lot have been bank credits. In a way, in the last recession in 2008, we saw banks very much at the eye of the storm. They got beaten to bits. At the time, banks took a lot of risk. They didn't have sufficient capital. And so banks were certainly not a place you wanted to be as a credit investor. But in the current recession that we're seeing, we're now looking at banks with very strong capital buffers in terms of tier 1 ratios. We're also seeing banks take a lot less risk than they used to take. Actually, a lot of the risk that exists in markets has now really been sort of packaged off elsewhere. So we actually think that banks are rather boring, and boring is good as a credit investor. It doesn't mean that we're very bullish about bank equity stocks. However, buying high-yielding securities, these subordinated COCO securities from banks, which may be yielding sort of 5-6% to us, looks like a really good place to actually have your money in a really low-yielding environment. So this is an area that we've really wanted to focus on in terms of searching for value in what is a very low-yield landscape.
But what Alice Gledhill nailed in this article, folks, been basically viral within the fixed income community, is the idea of, is it too late to take part? Mark, we're in August. We're heading for September. As you mentioned, record highs in the equity market. Is it too late to take advantage of these relatively sophisticated strategies? And the American phrase is the boat left the dock.
Well, not yet. I think that as an investor, you're always looking at relative value across assets, and you're asking yourself, where has the rally gone too far? Where is it overextended? Where is value depleted? And where are there still pockets of value that you can really play for? And relatively speaking, we do see bank securities as being cheap. We think that CoCos are very interesting relative to a lot of other assets in the fixed income space at the minute. So we would always sort of speak to investing more over the medium term than over the very short term. But intrinsically, we still see a lot of value in these sorts of assets.
So, Mark, when will they no longer be cheap? I don't know whether there's, a point where you say, okay, enough is enough.
Yeah, well, so these junior securities, the CoCos, are what we call tier one securities, and one of the things we look at is the valuation on the next most senior securities the banks issue up the value chain, and so the next most senior securities would be tier two securities, and so if we see this gap between tier one and tier two securities tighten materially, we would then say that there's not a lot of value, relatively speaking. But at the moment, that gap remains elevated. And frankly, even if the recession does its worst, we think that there's a very, very low risk of CoCo debt being written down as a result of actually triggering the capital triggers in these assets. And so actually, for the risks that one is taking, we actually think it's a smart place to be investing for now.
Well, Mark, thank you so much for that briefing, and we will continue. Mr. Dowding is with Blue Bay Asset Management. I really can't say enough, folks. If you're interested in global Wall Street, look to Bloomberg bond coverage out at Bloomberg.com, and of course on the terminal. The story by Ms. Gledhill was really industry-leading 2 days ago, I think it was. Coming up later, always interesting, David Malpass of the World Bank. There is a pandemic out there, front and center for Mr. Malpass and his bank. In the 8 o'clock hour. This is Bloomberg Futures. Futures advance up 5.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
If you want a president who defines the job as spending hours a day watching TV and zapping people on social media, he's your man. Denying, distracting, and demeaning works great if you're trying to entertain or inflame. But in a real crisis, it collapses like a house of cards. COVID just doesn't respond to any of them. To beat it, you've got to actually go to work and deal with the facts.
The former president managing the message over, and I really wonder, folks, you want, for our global audience particularly, the play in the zeitgeist in America is extraordinary. Do we go back to a traditional convention when the pandemic's over? I'm not sure on that. I'll leave that to David Weston and Kevin Cirilli giving us convention coverage, but just absolutely extraordinary. Whatever your politics, the last two nights on this new way of messaging, almost the infomercial of it, fascinating to see where we are 4 years from now within the convention strategy of the two parties. Right now, our strategy is to get smarter on fixed income. With us, Mark Dowding of Blue Bay Asset Management. He put us to sleep. I nodded off to sleep. I hit my head against the microphone here, folks, talking about COCOs. Let's do something basic as well. Mark, tell me about the nominal yield. Help me with the nominal yield of full faith and credit debt. What's it going to do over the next year?
Well, in terms of looking at the absolute level of yields, we need to start by the understanding that we're in a world where cash rates are lower than they ever have been. And so one has to look at sort of yield levels which seem to be defying logic, I'm sure, to many of your viewers. But we need to look at these in the context of the level of cash rates which are prevailing, and maybe an expectation in markets that cash rates are unlikely to actually go up at the Fed or the ECB, maybe for the next 3, maybe for the next 5 years. And so in this world, I think we've got to get used to very low yields for a long time to come.
Right.
We think we're going to be in a world where actually when we look at credit indices and the yields on credit benchmarks, they're probably going to be edging slightly lower over the course of the next 12 months. Maybe we see government yields start to move a little bit higher. But in this world, we should see returns which are better than cash, albeit much, much less exciting than we've been used to receiving in the past.
But Mark, basically, as Mr. Gross of PIMCO said, it's financial repression. He said that a few years ago. Mark, the money question this morning is, what does your world do to the stock market? When we finally get through this, do you perceive a stock market that can manage its way out of this bubble or whatever you want to call it? Or is there going to be shocks to the equity market linked off of what we see in fixed income?
Well, I think you're moving into a world where effectively the short-term risks have been mitigated in equity markets as a result of the policy action that we've seen, but you're potentially storing up problems for the future because clearly if you end up in financial repression driving very high PE ratios, at some point, as and when the policy stimulus begins to be unwound, if that triggers a more material rise in inflation and yields in years to come, at that point, if you see the discount rate from the bond yield go up, that can only mean that the equity market is likely to go in the other direction. And so I think in the here and now, it's enjoy it while you can as an equity investor, and financial repression is clearly driving stocks to new highs, certainly in the US. But you may think that in quarters and in years to come, we're probably likely to see a pattern of increased volatility and maybe more uncertain returns for equity investors. And I think, frankly, we need to understand that in a world of 0% interest rates, it's kind of a bit inappropriate to expect equity markets to go up 10% every quarter as they have done, maybe in the last few months.
And Francine, that's a surveillance break exclusive right there. Mark Dowling saying we're not going to see up 10% every quarter. I think that's important on a Wednesday.
Mark, what would be the catalyst for this change? Is do you have to see inflation, and do you have to really have strong, rampant inflation, or does a touch of inflation also change everything?
Well, I think a touch of inflation won't do very much because, if anything, central banks for the time being have been saying that they're happy to sit behind the curve and actually hold rates steady to correct for the past inflation undershoot. So I think that in order to be sort of talking about a materially different environment, you probably need to reach a point where the output gap is being closed, and we're sort of projecting a more robust growth environment. And so this may not be the case until at some point in 2021 that this is a factor that we need to be concerned about. But sooner or later, we're going to reach the point where higher yields are going to be problematic for equity investors. I just don't think that that's going to be the issue in the here and now. If anything, if there's a catalyst in the short term for equities to struggle, it may be more from growth disappointments rather than from the idea of higher inflation just yet. It's just too early to get bearish on inflation or bearish on central banks, but it will be a factor over the medium to long term.
Mark, thank you so much. What a terrific briefing. Mark Dowding there, Blue Bay Asset Management Chief Investment Officer. Now, coming up on Bloomberg The Open, we'll have a conversation also on markets and fixed income with Kate Moore, BlackRock Head of Thematic Strategy. That interview, 9 a.m. in New York, that's 2 p.m. in London, and this is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg Business Flash. Takeda Pharmaceutical reportedly is making final arrangements to sell its Japanese consumer healthcare business to Blackstone. According to Kyoto, the deal would be worth more than $2.8 billion. Takeda has been in a divestment mode since buying Shire last year for $62 billion. Bain Capital has agreed to pay $543 million if it fails to buy Virgin Australia Airline. That unusually high breakup fee helped win over the collapsed airline's administrator. Virgin's creditors will vote on the proposed deal September 4th. And the world's largest container ship line has reinstated its full-year guidance at a higher level. A.P. Moller-Maersk reported second quarter EBITDA that was close to the highest analyst estimate. The Danish company says it was able to serve customers under very difficult circumstances. And that is the Bloomberg Business Flash.
Karina, thank you so much. Greatly appreciated. Equities, bonds, currencies, commodities. Euro on a surge now, not through to recent record highs, but nevertheless, it gets our attention. Here, 119.50 on euro. No, I'm not going to round it up to 120 yet. Equities, they elevate today. The VIX, 21.60. Francine?
Tom, if you look at European stocks, so they are turning higher with these U.S. futures. So they seem to be following U.S. futures impetus. A lot of the focus is on optimism in the post-pandemic rally. I do think there is a correlation, as you rightly said, Tom, with yields and equities. Gold actually slipping back below $2,000 an ounce. We had some better than expected news when it came to inflation here in Europe. And then we also had some lingering questions, which is why the market in Europe certainly was a little bit off this morning over the future of the U.S.-China trade pact after President Trump said he called off last weekend's trade talks. So we'll talk trade, we'll talk equities. We'll actually talk U.S. politics and advertising with Sir Martin Sorrell, the S4 Capital chairman and founder. He's coming up shortly, and this is Bloomberg.
Since COVID ianze hatujakuwa tukienda kazi, so maisha imekuwa ngumu na inazidi kukua ngumu. So swali yenye tunajiuliza, kama hii imefika 1 million plus na situation cases bado zinaendelea kuenda juu, zikifika 5 million tutakuwa aje?
Hizi gari za biashara tumekosa pesa ya kulipa, hata the more inaonekana inaendelea, hata itabidi turudi ushago juu biashara imeharibika kabisa, hata tujui tutafanya namna gani.
you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg First Word News. Joe Biden is shooting down President Trump's attempt to paint him as a puppet of progressives. Democrats formally nominated Biden to face a president in November's election. Last night, the virtual convention included testimonials from the party's own guard, such as Bill Clinton.
The president who defines the job as spending hours a day watching TV and zapping people on social media, he's your man. Denying, distracting, and demeaning works great if you're trying to entertain or inflame. But in a real crisis, it collapses like a house of cards. COVID just doesn't respond to any of that. To beat it, you've got to actually go to work and deal with the facts.
A joint keynote address featured newcomers, mostly from the party's centrist wing. And the Trump administration is considering tighter sanctions on Venezuelan oil. Bloomberg's learned the measures could target crude swaps with companies in Asia and Europe. Last week, the U.S. seized the contents of 4 Iranian tankers carrying gasoline to Venezuela. Venezuela can't produce its own gas because of widespread mechanical failures at refineries. And we'll hear more in the coming days from the Postmaster General about his decision to suspend changes to the mail service until after the election. Louis DeJoy will testify in front of Congress on both Friday and Monday. Democrats and others were concerned that apparent mail slowdowns could hurt voting by mail. And Saudi Arabia is keeping up the pressure on OPEC Plus nations that have been exceeding their oil output targets. Saudi King Salman called the president of Nigeria to emphasize the importance of complying with production limits. OPEC and its allies will discuss compliance today on a video conference. Nigeria, Iraq, and several other nations consistently fall short of pledges to limit output. Global news 24 hours a day on air and a Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Tom, Fran.
Karina, thank you so much. Greatly appreciate it. This is the interview of the day. If your life has changed by the emptiness of our cities, if there's one thing Francine and I have seen over the recent months, it's the sheer global emptiness of our cities. Someone who's filled that office space for decades, back to his acquisition of wire and plastic products a few years ago, was a young Martin Sorrell. Sir Martin joins us today. And Sir Martin, I've been dying to ask you this question. Is the office...
Am I an old Martin Sorrell now, Tom?
No, you're well preserved. What I want to know, Sir Martin, is the office dead? You're the one that put thousands of people at WPP into offices, creating that energy. Is work from home really the future?
Well, I think it's going to change, Tom. I mean, I know there's a lot of controversy about that, particularly real estate developers don't like to hear this, but if I talk from our own experience at S4, we have 2,600 people. We actually increased the number of people in S4 since the beginning of COVID. We've gone from about 2,400 to 2,600. So we're hiring as the holding companies are jettisoning about 50,000 people and making provisions for all that real estate. Omnicom took a provision against 1 million square feet in their Q2 numbers. IPG, 500,000 square feet. What we're finding, and our workforce, Tom, is a young workforce, despite the fact that I'm 75. I'm the senior monk, as they call me. On the content side, we have 2,000 monks whose average age is about 32. We have about 600 mighty hivers on the media side whose average age is about 25. They're on the young side. They tend, some of them work from home from their parents, or work from home from their parents, or as couples, or with kids, and they lack the resources. So those people probably are a bit more reticent to dress as offices. But generally, Tom, to answer your question directly, our people want to spend about 2 or 3 or 4 days in the office. They want to be living in more dispersed parts of the country, whether it be the US, the UK, we're in 30 countries. So I think working from home and dispersed working, given the level of connectivity we have, and our people are not just digital first, they're digital natives. I mean, this is bread and butter for them. And even before COVID, they were working 24/7 from home in a flexible way. So flexibility on commuting, Tom, so not having to come in at 6 or 7 in the morning or go home at 7 or 8 at night. but being able to flex.
So I don't mean to cut you off because of time. Francine wants to get in here, Sir Martin, and I got one more question on this, and I know Francine wants to go in another direction, and that is simply, what is the government policy that would be most efficacious? What do you need from Prime Minister Johnson, the next president of the United States, whoever that may be? What's the policy that moves business forward pre-vaccine?
Well, vaccines are critically important, and I think by Q2 of next year, we'll have an approved, regulatory, distributed, and vaccinated population. Now, there is the big question about whether people will be vaccinated or not. I saw a poll in the US which said a third would not. But essentially, to come back to what needs to be done, hardware and software infrastructure, a re-education, reskilling. COVID-19 accelerates what's happening on digital transformation, digital disruption, and makes those public-private partnerships where we reskill and re-educate workers even critically more important. I read an article this morning, 750,000 job losses in the last couple of months here in the UK. The furloughs here have postponed the evil day. The furloughs come off in October. We will see an acceleration of unemployment. Technology, in my view, destroys jobs. You know, people talk a lot about purpose. The purpose of S4, we put it very simply, is to create jobs in our industry at a time when our industry is shedding jobs, when they're shedding real estate. What we're trying to do is employ more people and give them encouraging and careers. Yes, Francine.
So how much advertising spending is there out there? What sectors, what companies are ready to spend in this kind of environment?
Well, the V-shaped sectors, as I call them, would be the tech sector, obviously healthcare, in-home games and entertainment and online shopping. And even the established retailers, those that have moved their model to an online model. 1/3 of the US population are trying to buy or have tried to buy and succeeded in buying online essentials and food during the pandemic. We saw with SARS in China a massive shift of the Chinese consumer to online. So everything we're seeing, Francine, through COVID-19 is just accelerating digital disruption and transformation at the consumer level, education, communication, things like we're doing here now. I'm sitting talking to the office instead of coming into the studio. We're seeing it at a media level. We're seeing newspapers and magazines dropping like flies because the paper versions aren't profitable and they aren't environmentally friendly. And last but most importantly, enterprises are accelerating their digital disruption and transformation. There is no status quo anymore, Tom, Francine, to disrupt. Well, if you're going to take an exceptional charge for digital transformation, the profitability in Q2 was a disaster. So what do? You get on with it as quickly as possible. Average life of a CEO is about 5 years. Now, the whole stage has been disrupted, so you might as well get on with the change. And the catalysts are huge. We're going to disrupt here with Sir Martin and come back with him and continue this discussion. Tom Keene and Francine Lacroix with futures up 6, Dow futures up 52. Coming up on Balance of Power, I'm really looking forward to this. Cass Sunstein, you know I loved his book Impeachment, where he didn't mention President Trump's name even once. Cass Sunstein on our judiciary and Cass Sunstein on the politics forward in the 12 o'clock hour today with Mr. Weston. Stay with us with Sir Martin Sorrell. This is Bloomberg.
We were laying down in the bed, just sleeping, and it startled us. All of a sudden, we hear this big tremble. It trembled our house, and then it shook our bed. And we was like, what in the world was that? I didn't know what it was. Honestly, I didn't even know if it was earthquake or not. It really startled me. didn't even know that earthquakes actually exist in North Carolina. So I was really startled. It was small, thank God. Nothing happened to our house, nothing broke. I just didn't realize that it would happen here in North Carolina, honestly.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Well, let's get back to Martin Sorrell of S4 Capital, who's still with us. We were talking with Sir Martin about some of the landscape, who's spending, who's not, digital natives, and of course the fact that maybe some of these trends in terms of the technology were accelerated because of COVID-19 by a couple of years. Sir Martin, I want to ask you about the U.S. election. What does it mean for spending? If we don't have natural conventions or normal conventions, but we do everything by video, is it good or bad for the advertising world?
Well, what we've seen, Francine, you have to remember that S4 is a purely digital company, and we claim to be faster, better, cheaper, and that actually is showing up in reality. But what we're seeing is a few things. Firstly, animation has gone through the roof. Secondly, robotic camera work and robotic production has gone through the roof. And then thirdly, the conversion of live events to online events. And as you saw with the convention, or you're seeing with the convention, it's conversion to an online event. And people forget that the tech companies, which is one of the V-shaped sectors that I mentioned, the way they sell their products and their licenses is through conferences, live events. You know, they have 10,000, 20,000 people in Las Vegas or San Francisco, or where it happens to be. What we've done is been heavily involved in converting those events to online events. For example, on sports, you know, we entered into agreements now with some of the major leagues on converting their live events to virtual streamed events, using very advanced photography and camera work and streaming devices to make the experience for the crowd, for the fans even more interesting. So it's not true to say in the digital area. I mean, media spending this year will be about $500 billion. Last year was about 550 to 600. The compression has come on the traditional side. The ad holding companies in Q2 were down between 10% and 26%. That was the worst. MDCI, I think, a smaller holding company, was down by a quarter in Q2. We're yet to see what happens with WPP, but it sounds from what we're hearing it's somewhere like 15 to 20% down in Q2. We were up in Q2 with a purely digital company. We bottomed in April. We improved. We had positive growth in April, around 3%. We improved in May to 5%. You'll see when we announce our results on September the 19th, or September the 9th, what happened in June. We went up, and we said we've indicated double digits in June. And in July, we had a very strong start to the second half. So digital advertising, Francine, is very strong. Still.
Okay, but is it enough to replace normal advertising? And we'll have to see what WPP say and things like that. We don't know yet. But just in terms of trends, if everything moves online, you may benefit because you're in the digital space, but will a company just spend less on advertising, or do they spend that money on technologies?
Procter, for example, I mean, we haven't mentioned the package goods there, which are much more U-shaped sort of recovery. But with Procter, it's a very narrow U-shape because you can see they were up 6% in Q2, the last quarter of their fiscal year. And what's happened there is because of their product portfolio, they're out of food. Unilever still have a food business, home service or food service business, ice cream business, which is affected by lack of distribution. But in the packaged goods sector, the focused packaged goods companies like a L'Oreal, like a Nestle, like a Mondelez, they tend to and their product portfolios tend to react better. They're much narrower U shape. The L shapes obviously are travel and hospitality, but the four I mentioned in terms of tech and healthcare, in-home and gaming and entertainment and online shopping obviously make up for it with a very strong V-shaped pattern to it. And the answer to your question is digital advertising this year will be about the same as it was last year, maybe up a little bit. It's the traditional areas of TV, free-to-air network TV, traditional radio rather than digital radio, traditional outdoor, print under pressure. You know, Rupert Murdoch closed what? 100 titles, was it? Over 100 titles in Australia and New Zealand just recently.
Right.
We're seeing so many newspapers and magazines in their old formats. It's not that news is out of fashion; it's in fashion. I mean, Donald Trump, the president, really probably has been the single most important factor for the news industry, for you, Francine, for you, Tom, in terms of people watching and listening to your programs. So I think the digital landscape is set fair. It's now about 50% of that 500 billion, about 250. We reckon by 2024 it'll be 2/3 of the market, and will continue to grow into Q3 and Q4 and into 2021.
Sir Martin, I've got one final question. I got like 8 ways to go here, but I got to go back to something you just said moments ago. Do we blame you for the crowd noise in the Premier League football games? Is the crowd noise your fault?
No, it is not our fault. And I must say, it's not good watching. I watch cricket, Tom. It's not good watching a silent cricket match. The Pakistanis, actually, when they're on the field, they talk an awful lot. In fact, I saw a little clip which analysed what the Pakistani fielders were saying, if you understand what I'm talking about, what the Pakistani fielders were saying whilst the English team were batting. But quite interesting. But no, I prefer the crowd noise, and so I don't mind it. I disagree with you, Tom.
Okay, very good. Sir Martin Sorrell, thank you.
All right,
so
Sir
much.
Martin,
Thank you, Tom. Thank you, Francine. Thank you.
Tom, I have like 2 minutes in the break to teach you about cricket.
I'm trying.
He's
I'm
never
trying.
watched cricket, Sir Martin. So
it's
we
hopeless.
need to,
John Riding has been helping for years, along with Raghu Rajan and Francine. I'm working on it every day.
Yeah. Leave it with me, Tom. You'll be briefed. Martin Sorrell, S4 Capital Chairman, joining us. Up next, Martin Ratz, Morgan Stanley Global Oil Strategist. This is Bloomberg.
isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now let's get on to commodities. And oil prices have eased from a 5-month high after a report signaled that U.S. gasoline stockpiles are actually surging. It comes ahead of a meeting of OPEC and its allies to assess its supply agreement. Well, joining us now is Martin Ratz. He's Morgan Stanley Global Oil Strategist. Martin, great to have you on the program. What are you expecting to hear from OPEC Plus? And actually, it's been pretty much stable, you know, independently of what everyone has been saying. So what can OPEC Plus actually do?
Yeah, thanks for having me. You're right to point out that after the very tumultuous and exciting March and April months, the volatility in oil prices has reduced quite a lot. And prices have been much more stable recently. Having said that, though, even though prices look much more stable, there's still an awful lot going on in the background. If you look from a top-down macro perspective at the oil complex, it's sometimes useful to simply realize that oil is just another commodity, and or at least to take that perspective, and to say, when do commodities do well? Well, they do well when the dollar is weak, when we start getting worried about inflation, when we have economic recovery, when we have growth in the money supply. Recently, we've had all of these factors that has provided a great tailwind to the broad commodity complex, and oil has also benefited from that. But if you then look at the bottom-up sort of barrel counting perspective of the oil market, you're seeing more signs of weakness. The demand recovery is still very fragile. Some of the curtailments in North America are slowly being unwound. Chinese imports are starting to soften. Refining margins are very low. And within that relatively complex set of top-down and bottom-up factors, OPEC needs to strike a balance. My expectation is that they simply will execute the plan that they communicated to the world back in April, and they simply execute that schedule, which is effectively set until well into 2022. So an incremental 2 million barrels a day in August was the plan, and I think that's the schedule that they're on.
But Martin.
Okay, guys, I'm placing a stop for euro at 119.345. Stop on profit for 119.345. Okay.
I think it's very important that they stick to the agreement. I mean, the OPEC Plus group is a very large number of countries, and to orchestrate production cuts of this size and relative to the agreed baseline, OPEC is running now minus 7.7 million barrels a day. I mean, this is a historically large OPEC cut. So to have this deeper cut agreed by so many countries, I think the only way to really be successful, or to kind of to keep the group together, is to simply execute on the plan. And the plan that was set out over the Easter weekend back in April is a very long-term plan. It has scheduled unwinds of these cuts.
Position closed on euro at 119.345.
Unwounds would open up so many, topics of negotiation again. The only way forward is to simply stick with the plan. In August, the quota is a 7.7 million barrel a day cut relative to July, when it was still a 9.7 million barrel a day cut. So, but all of that was already negotiated as per April, and I think simply for the coherence of the group, they'll need to stick to the original agreement.
Martin, Tom Keene in New York, good morning to you. I want to go to your physics background and your really, really thoughtful note on the future of big oil. It was on European oil, and we don't talk about individual names here. But Martin, I just want to go to the law of motion here. Are these big oil companies at rest, or are they actually in motion and will stay in motion towards some new paradigm?
Oh, they are in tremendous motion. The rate of change that is already taking place and will become more apparent over the next several months and several quarters is phenomenal in these companies. The coronavirus crisis has led to a structural rethinking of strategy on a sort of 5 to 10 year view in all of the European oil majors. There is a clear realization that that betting on or assuming this sort of open-ended structural oil and gas demand growth year after year, as we've been accustomed to for decades, that may still happen, but it's much more of an open question, and there are scenarios where that simply doesn't happen. And if the traditional fossil fuel business enters a new paradigm, then also other businesses models need to build up. New energies, renewables, all these things. And there's a huge degree of change going on there that we will hear more
but is it,
in months to come.
Very quickly here, we're going to run out of time, Martin, but it's an important question. Are they going to be able to maintain cash flow for dividend payment with the new paradigm they're heading towards?
Yeah, frankly, this is the billion-dollar question, that we put it mildly. So all these dividends have been reset lower, or at least the vast majority of them have been reset lower, and that really helps. The problem with the energy transition is that it's hugely capital intensive. Now, in the fullness of time, that will be offset by, hopefully decent returns. But for a period, it could be 5 to 10 years. We're looking at very high levels of capital expenditure that are required to fund the transition. Producing a unit of energy from, say, a wind or a solar project is about 5 times as capital intensive as producing a unit of energy from oil or gas. So as you switch from one business model to the other ones, you're looking at a period which is a multi-year period of a capex hump to overcome.
We have to extend this conversation, extremely timely. Here's with Morgan Stanley, their global oil strategist, Martin Ratz. Really can't say enough about the engineering that he brings to his analysis. We're going to engineer forward to foreign exchange. Really, it's simple, dollar weakness, and we're seeing that sustained today. Daniel Katzev, BNP Paribas. From London, from New York, futures up 6. This is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it. That makes me confident that we are going to do everything we can to determine safety.
This morning, well, so much for the surge in yield. Bonds reprice back near perfection. The residual, that would be the real yield. Good morning, John Farrow. The real yield, it turns more negative. Happy Valentine's Day. You remember Valentine's Day for the S&P 500. Stocks surge, and it's not just big tech. And live from Milwaukee, well, day 2 of a virtual convention. A virtual roll call vote got very nice grades from the zeitgeist, with appearances from General Powell, an appearance from Mrs. McCain. The Democrats, they choose Biden. Good morning, everyone. This is Bloomberg Surveillance from New York. Francine Lacroix, ensconced in London as well. Francine, beneath the radar this morning is record demand for a 30-year negative yield. This would be in Germany, and I'll be honest, I got all the answers, and we talked to all the fancy people. That doesn't make sense, does it? Record demand for a negative yield for 30 years.
Well, remember, Tom, we had one of those auctions about 4 or 5 weeks ago and at the time we said it doesn't make sense. We had a good conversation with the chief investment officer of Blue Bay Asset Management. I get, it's hard to see what people are looking at. Partly it's, tracks gold in terms of that risk appetite and cautiousness, but certainly we do need to spend a bit more time looking at the German market, looking at European yields to see what it means for the future.
It is the oddest time. The chart is one big disinflationary chart over decades, and the key item there, folks, is 30-year paper, not the Swiss 20-year, but 30-year paper at a negative yield, and they are lined up to take it. That is odd. With our first word news in New York City, here's Karina Mitchell.
Tom, Democrats have made it official. They've nominated Joe Biden to take on President Trump in November. Biden received the more than 2,300 delegates needed in a virtual roll call that was a video tour across the nation. Past Democratic stars like Bill Clinton and future ones like Alexandria Ocasio-Cortez made short appearances. So did former Republican Secretary of State Colin Powell.
Joe Biden will be a president we will all be proud to salute. With Joe Biden in the White House, you will never doubt that he will stand with our friends and stand up to our adversaries, never the other way around.
And tonight, the party will hear from Biden's running mate, Senator Kamala Harris. Now, the Trump administration sees a path to a pared-down $500 billion stimulus deal. Bloomberg's learned the package would eliminate the biggest areas of disagreement between Republicans and Democrats. It would include financial help for the Postal Service, aid to schools, and money for businesses to keep their workers employed. House Speaker Nancy Pelosi suggested Democrats might also agree to a smaller deal. And President Trump is raising questions about the future of that trade deal with China. The president says he called off last weekend's talks with Beijing. He said he doesn't want to talk to China right now. The president called China's handling of the coronavirus, quote, unthinkable. Meanwhile, the coronavirus outbreaks in Florida and California are showing signs of easing. In California, the number of new cases was less than 60% of the 14-day average. Hospitalizations rose slightly, but are now down almost 30% from a peak in July. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thanks so much. Let me look at equities, bonds, currencies, commodities right now. It's actually a really interesting data check. Not a lot of movement, but the movement that there is fascinating. Equities continue to advance. Fractional, but we'll take it after that record S&P 500 day yesterday. Dow setting at 27,760. Dow points up 43 points on the futures. This morning, yield comes in and continues to come in. 30-year bond, we mentioned 30-year Germany, 30-year U.S. from a 141 now over the last couple days into 1.37. We've come back about halfway on the high yield move. The TIPS yield is important, negative 1.05. We have it to 4 digits there because it's the way we do it here at Bloomberg Surveillance. Negative 1.0473 on the real yield. That would be the nominal yield, less inflation expectations. And I'd note the dollar, well, it's fractionally weaker today. That would be something. I'll tell you, Francine, to see a 120 euro, that changes the discourse.
Yeah, it certainly does. And I know Kid Juice has been talking quite a lot about Eurodynamics. Tom, I like 4 digits. That's a surveillance way. This, of course, all is ahead of the Federal Reserve minutes of a July committee meeting that may give us clues about inflation targeting. What I'm looking at in Europe is European stocks ticking higher along U.S. futures. There's a bit more optimism, I would say, than there was yesterday, although Wall Street yesterday did hit an all-time high, and then gold slipping back below $2,000 an ounce. And then I just put VIX, Tom, for good measure because it's August.
It is August, and it is a different August. I remember sitting with Senator Kerry and his people in Boston 2004, meeting Senator Obama for the first time. Maybe that was a convention of a different time and place. Let us listen to a convention of 2020.
If you want a president who defines the job as spending hours a day watching TV and zapping people on social media, he's your man. Denying, distracting, and demeaning works great if you're trying to entertain or inflame. But in a real crisis, it collapses like a house of cards.
Donald Trump inherited a growing economy and a more peaceful world. And like everything else he inherited, he bankrupted it. When this president goes overseas, it isn't a goodwill mission, it's a blooper reel. He breaks up with our allies and writes love letters to dictators. America deserves a president who is looked up to, not laughed at.
Joe Biden will be a president we will all be proud to salute. With Joe Biden in the White House, you will never doubt that he will stand with our friends and stand up to our adversaries, never the other way around.
And as for the gentleman from Ohio the previous night, to see General Powell there, and I believe also an appearance by Mrs. McCain, is of note at the Democratic convention. It'll be interesting. I saw they're building the scaffolding out on the White House lawn. As the president will rebut these comments here in the coming days. Right now, we migrate to Congress, to Capitol Hill, where Emily Wilkins is up watching every single moment of convention coverage, and we're thrilled she could join us today because nobody up in the Hill really cares about the coverage, Emily. They care about trying to get a stimulus bill together. The Republicans have come back with, I believe, $500 billion. Are we anywhere near an agreement just on the basics of pandemic assistance?
So we thought the answer last week was no, but yesterday we saw not only this $500 billion bill come out and Republicans sort of say, hey, we're still open to this, but we also saw Speaker Nancy Pelosi come out, and she suggested that Democrats would be open to a smaller stimulus package and then try and get some of their bigger priorities passed after the November election. So it certainly seems like there is sort of some new momentum on Capitol Hill to actually get something done.
A delicate question, and I'm hoping apolitical. Is there a tone of equal compromise here, or is one of the parties moving faster towards the middle?
I think to a certain extent you're seeing perhaps a bigger shift from the Democrats. Of course, we'll see what Pelosi actually meant when she said that she'll be open to a smaller stimulus. That's something Republicans have been proposing for a while, but Democrats have really held out on, saying there needs to be state and local funding. That's a point they've been very, very adamant on. However, I also know that Speaker Pelosi, she did get some criticism for not getting a deal done, and she has gotten some pushback from within her own party, particularly Democrats facing tough races in November, saying, hey, you can't let us go back to our districts empty-handed. We need to have something to take to our constituents and show them that we've done.
Emily, with that smaller stimulus package, what would not be in it that's essential? Or do we know, what would it be funding?
Sure. So right now the package includes funding for education, for business to keep their workers employed, the PPP program. The one the Republicans put forward changes basically a loan to the Postal Service into a grant. But things that aren't in there, state and local funding, there also aren't another round of stimulus checks for Americans. That was that $1,200 check that went out. Democrats want to do another round of that. That's just not in this bill that Republicans have put forward. And it's hard to imagine that it would be in a slimmer bill simply because the price tag on that is so big.
So if there is an agreement, how fast can it come and how quickly can the money be dispatched?
That's a great question. The House is coming back into session this Saturday for a particular vote. The Senate is still out, so they would have to need to come back into session as well. Then another thing to keep in mind, government funding does run out on September 30th, and something does need to be done about that. So there is a potential that this particular skinny stimulus that we're talking about could be included into a larger package to fund the government, and we might see that come at some point in September.
Emily, thank you so much. Emily Wilkins with a quick brief there on the stimulus. Fascinating to see how that moves through the week into the Sunday talk shows and into next week as well as September comes onto the horizon. Coming up later, we've been doing this a lot with Mr. Malpass, David Malpass, formerly working with the Trump administration, and of course for years with Bear Stearns. He is the World Bank president, and we've been getting updates from him on the World Bank's place, its position in providing aid in this pandemic. We'll get a briefing on the pandemic and the World Bank here in the 8 o'clock hour. David Malpass coming up. Stay with us. Futures up 5. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. Futures up $5 right now. A little bit of a tinge of weakness after 1, 2, 3, 4. What was it? 5 days of dollar weakness. Euro resets this morning solidly, and my eyes are failing me. I'll get it. There it is, Francine. 119.42 on euro. My eyes are failing me. Francine's eyes never fail her. Right now, we want to talk to BNP Paribas. They have very quietly over the last 6-7 years put together what I would call a math-based research house. And they lead in foreign exchange with Daniel Katzev, who joins us, head of their FX strategy for North America. Dan, I love your research report, short, concise, and very mathy. Describe the mathematics of a weaker dollar. Is it a gradual grind, or is there an inertial force to something surprisingly weaker over the coming months?
I think it's a grind, but you know, before you know it, you actually start to make some progress towards some levels that people didn't think we could get to. Slow and steady. It's a momentum trade for the first time in FX in a very long time, 5 years at least. So I think a lot of people in the market have forgotten what momentum looks like.
And the momentum there is that inertial force where it really not gets out of control, folks, but just every day it's there and you wake up to it. Is it about flows or is it about rates?
I think it's actually the conflux of those two things, because you had the dollar starting the year at pretty expensive levels, has been expensive for a while. U.S. rates came down a lot, cash rates it came down a lot, and it means that the compensation for staying exposed to dollar risk for global investors is no longer there. And that's, we believe, leading to flows, which are investors, you're exiting their dollar exposure, reducing their dollar exposure, hedging their underlying dollar assets in FX terms.
Daniel, what's the most interesting currency pairing out there? Is it euro-dollar or euro something else?
Well, euro-dollar is interesting because it's got some momentum for the first time in a while, and it's breaking up to new levels, so that's catching a lot of attention. Dollar-yen is interesting for the opposite reason. It's interesting because it's really not moved yet. It seems like we have a little bit of a mini equilibrium in dollar-yen, and that's surprising to us, surprising to a lot of people who would have thought that in this kind of environment, dollar-yen would really be breaking down. I think that will still happen. If everything happened at once, then there wouldn't be anything for anybody to ever do in FX. So I do think that we'll see dollar-yen begin to participate in this, become more correlated with what's happening in euro versus USD, and break down towards 100 over the next few months.
But Daniel, if you think that actually the dollar is depreciating, what's supporting euro?
Well, I think it's it's basically the dollar move. The euro was held back by these systemic concerns related to whether Europe would be able to get together with a mutualized aid response to the crisis. This has been addressed, not so much that it's the best response ever, but really that it's kind of good enough for the euro to participate in what is really a dollar-driven move. This is about the dollar. Not really about anything, not the market saying that everything's great in Europe. This is about market saying the dollar is too expensive and you can't justify that level with the current rate differential and right. Low real yields.
Dan, one more question, then I want to come back and get a little more esoteric here. Real simple, and we've been asking everybody this question. Where does the politics impinge on other strong currencies? I mean, on a euro as an example, I'll let you pick the currency. Where does strong euro begin to get a political pushback in Europe?
This is a very important question because whenever we have a big move in the dollar, obviously it has impacts on everybody else's economy, and you want to see who's going to push back first. Canada is a country, obviously, which is very exposed to U.S. dollar exchange rate because of the big trade linkages, and so we would think we would get some monetary policy response to USD weakness sooner from Bank of Canada than other central banks. That's probably why the Canada dollar is not moving as much as some of the other currencies. In Europe, I think you will get you could get some reference to the exchange rate as suppressing inflation or holding back activity, but I think they're going to be careful. There's been a lot of obviously trade tension over the last few years. The last thing the ECB wants is to be seen as talking a lot about the FX. I don't think we're going back to the old days of Trichet, really verbally intervening very aggressively.
Okay, Dan Katzer there with a terrific dollar brief, and we'll come back on a little more of an EM look as well. Mr. Katzer with BNP Paribas. On the open today, they win. They have Kate Moore from BlackRock. Why is this important? Because you're not in the stock market. She is. She's had the courage to stay invested and enjoy a record Standard & Poor's 500 back to where it was on Valentine's Day. Kate Moore in the 9 on John Farrow's The Open. This is Bloomberg. Good morning.
you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, we were having a strong conversation on currencies. Let's get back to Daniel Katsev, BNP Paribas, head of FX strategy for North America. Daniel, what do you do with pound right now? So there's, of course, you know, like any other country, it's lockdown concerns, whether schools reopen, and then you have this, you know, lingering I guess, debate on what happens with Brexit, whether the EU and the UK find a deal. If they find a deal, how positive will that be for sterling?
Oh, no, we think that would be positive indeed. But you know, I think there's a bit of confusion on the pound. There's a lot of focus on the sterling USD rate, which obviously is higher, above 130. We think that's mainly dollar driven. If you look at trade-weighted pound or euro sterling cross, sterling's still trading with a fair degree of discount. So I think the market is still at these levels, you know, pricing in a decent chance of a deal happening. So you might not see as much a reaction as maybe you would expect. But it would definitely, it would clear the way for sterling to participate in a broad dollar move, and you could push, you know, much even through 135, et cetera, in sterling USD.
Where do you find the most interesting pairing? I know in some of the research that you put out, I know you're looking at Noki Stocky, which I wish I had a chart for it, but I don't right now. We don't often looking at it, but do you see much divergence going forward?
It goes back to sort of, you know, what we were talking about before the break, that, you know, different central banks are going to have a different reaction function to dollar weakness and strength in their own currency. So that creates some relative value opportunities. We've been watching, as you mentioned, the Noki Stocky cross, also looking at the Aussie Kiwi cross. That's one which has pushed to relatively high levels because the Reserve Bank of New Zealand has been much more aggressive in easing policy. But this is kind of, you know, little trades along the margins of what's really a really big theme, which is broad dollar weakness. So for big moves, ones that, you know, long-term investors, et cetera, are going to notice, it's mainly going to be on the dollar pairs, less so on the crosses. And what you'll see is as the dollar becomes more and more of a driving theme, volatility in cross rates goes down, volatility in things like euro yen goes down because dollar is moving against everything. That's kind of the world we're expecting.
This is really interesting, folks, and what's so important here is it pivots us well off safe haven like Swiss franc. What's the opportunity to play against Swiss franc?
Well, Swiss franc is because it's expensive versus the euro on a trade-weighted basis. It doesn't show up as a cheap currency the way the euro would, because it doesn't have as much of the dollar-Swiss exchange rate is not so important for the Swiss economy. So it doesn't really have the same structural story that a lot of the other dollar pairs have. And it means that dollar Swiss will be probably more stationary. It won't really be part of the big dollar move.
Okay, but where is the opportunity in Swiss franc? I mean, there's always got to be something to play against Swissy.
I think for the Swiss franc, the opportunity is still in the euro-Swiss cross, which is at historically low levels. The SNB, Swiss National Bank, is obviously not keen to have it break down any further. They've told us that they are prepared to continue to intervene as they need to prevent that. So risk-reward to us is skewed to the top side in that cross. So we'd see dollar-Swiss kind of stationary, but euro versus Swiss should go higher.
I mean, is there anything interesting in some of the Central European markets, some of the currencies that we should be watching out for there, Daniel?
Well, those have had pretty good moves already. I mean, our EM team has been generally bullish on emerging market currencies, but they've increasingly shifted their focus away from some of these Central European currencies and put more weight on Latin American currencies where there's still value, although they also did add ruble to their long EM basket this week. So that's one to keep an eye on.
Daniel, thank you so much. Daniel Katzif there of BNP Paribas with a full roundup of some of the currencies that you should be watching. Now, coming up next, Candace Browning, Bank of America Securities Head of Global Research. They have an interesting survey out, so we'll have a lot more talk on that. This is also what we're looking at. So President Trump says he canceled the talks with China. It did initially give a bit of concern to the markets, but now European stocks are taking higher. U.S. futures also on the up. Investors quite more optimistic than they were a couple of hours ago in this post-pandemic rally. This is Bloomberg.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg First Word News. Joe Biden is shooting down President Trump's attempt to paint him as a puppet of progressives. Democrats formally nominated Biden to face the president in November's election. Last night, the virtual convention included testimonials from the party's old guard, such as Bill Clinton.
If you want a president who defines the job as spending hours a day watching TV and zapping people on social media, he's your man. Denying, distracting, and demeaning works great if you're trying to entertain or inflame. But in a real crisis, it collapses like a house of cards. COVID just doesn't respond to any of them. To beat it, you've got to actually go to work and deal with the facts.
And a joint keynote address featured newcomers, mostly from the party's centrist wing. We'll hear more in the coming days from the Postmaster General about his decision to suspend changes to the mail service until after the election. Louis DeJoy will testify in front of Congress on Friday and Monday. Democrats and others were concerned that apparent mail slowdowns could hurt voting by mail. The Trump administration is considering tighter sanctions on Venezuelan oil. Bloomberg's learned the measures could target crude swaps with companies in Asia and Europe. Last week, the U.S. seized the contents of 4 Iranian tankers carrying gasoline to Venezuela. Venezuela can't produce its own gas because of widespread mechanical failures at refineries. And staying on oil, Saudi Arabia is keeping up the pressure on OPEC Plus nations that have been exceeding their oil output targets. Saudi King Salman called the president of Nigeria to emphasize the importance of complying with production limits. OPEC and its allies will discuss compliance today on a video conference call. Nigeria, Iraq, and several other nations consistently fall short of pledges to limit output. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thanks so much. You make your luck at Bloomberg Surveillance, and what we try to do is book guests here that are in the game within the zeitgeist of the moment. As we saw Home Depot and Walmart yesterday, so Target this morning. These are extraordinary numbers. They are game-changing. That's not a typo on your screen on radio. All I can say is 24% is 24%. Target here in this consumer and retail revolution of the pandemic that we're living in. There's all sorts of data in here. Gross margin of 31%, and of course, sales surging here. I don't have a digital number in front of me, but I'm sure it's like Walmart up 97% yesterday. Francine, the reason this works so well, and I want you to bring in Candace Browning, is Candace Browning owns the high ground. Bank of America taking the II trophy here for Research House. It's always a battle between the major houses. And what's so great about Candace Browning is for decades we would steal her research on aviation and airlines just to get smarter. It was that simple.
Yeah, we don't steal anything anymore, Tom. We protect copyright. But in January, a Bank of America survey found that global supply chains are undergoing a tectonic shift. Now the latest survey says that COVID-19 has turned these tectonic shifts to visible fault lines. And we're delighted to be joined, as you mentioned, by Candace Browning, head of global research at Bank of America Securities. And frankly, when the big guns write research papers, you should sit up and listen. So Candace, thank you so much for joining us on Bloomberg Surveillance. I mean, the premise is basically saying that these supply chain shifts are real, that they're tangible, that they will make a big difference. And you also mentioned that there's, a $1 trillion cost in reshoring. Will companies, first of all, be able to afford that?
Well, yes, companies, we think, will be able to afford it. Based on our analysis, we think that the return on capital employed, if you assume a $1 trillion CapEx cycle over a 5-year period, we think that the return on capital employed will actually decline by just 0.7%. So not a big number. And if you look at free cash flow to sales, you'd see a decline of about 1.1%. So again, not a huge number. Now, you could argue that perhaps financial markets will look at that decline in profitability and they may assign lower multiples to stocks going forward. But on the other hand, if these supply chains are moved back either to the United States or to other locations, you're going to see less disruptions and less volatility in earnings, and therefore maybe financial markets will not mark stocks down if this $1 trillion in CapEx is spent.
Again, why are these supply chains actually shifting? Is it U.S.-China tensions, or is it really just so much pressure from the pandemic? And once you move a supply chain, can it go back to the way it was?
Yeah, Francine, I think that's really the key question. So when we first wrote this report 6 months ago, nobody had heard of COVID, and unemployment was, near all-time lows. And of course, the world has dramatically changed since then. But even 6 months ago, companies were talking about moving their supply chains, and there's a lot of reasons for it. First of all, one of the main reasons that supply chains were moved in the first place is because China was so much of a less expensive alternative. Well, that arbitrage has significantly narrowed. That's a result of wages going up in China, but it's also a function of more automation coming into manufacturing, which has reduced manufacturing costs here in the United States and in other locations. So number one, the cost arbitrage has narrowed. And then you throw in national security concerns. And then in addition, you throw in this idea of ESG concerns. So you think about carbon footprints. Well, the average t-shirt actually makes 2 trips across the Pacific before you purchase it. And the fashion industry has the second highest CO2 footprint, just behind oil and gas. So there are environmental concerns, there are social concerns, there are governance concerns. So you've got ESG, you've got this labor cost arbitrage, you've got national security, and then you throw in COVID. And what COVID did is it disrupted 80% of the companies who have global supply chains.
Yeah, Candace, I think Savita Subramanian has really been industry leading on this. I did some work with her at Davos that I thought was just brilliant on ESG. Candace, I want to get out front of your next thematic piece, which I'm going to call the digital dominance. I mean, it's absolutely unreal what we're seeing from Target, what we're seeing from Walmart, what we're seeing from Home Depot, and then you've got Amazon as an overlay. How will Bank of America study the persistence of the digital dominance we see in this pandemic?
Well, I think it's a great question, Tom, and I think it really underlies, the point that, yes, we're in a period of profound distress, but out of that is coming some profound opportunities. And this digital disruption is certainly one of them. And I think it's got real legs, and we're going to continue to see it operate in so many different industries. So how are we going to study it? We're going to do it the same way we did it with the supply chain. We've got, we cover 3,000 companies. We have more than 500 analysts covering those companies, and we're going to go after those analysts and survey them.
As you know, Candace, one of the seminal pieces here, this has got to be 15 years ago, at the time at Credit Suisse, was Michael Mauboussin, that there would be few winners within the internet, within the networking space of digital. There would be very few winners. You follow 3,000 companies. Do you assume that in 10 years, you're going to be following 1,500 companies because of digital dominance?
Actually, that's a very interesting point. And one of the pieces that we put out yesterday actually argued that if there is this reshoring of supply chains back to the United States and a CapEx cycle begins here, actually the companies that are going to benefit, interestingly, are the smaller companies. Because, and by the way, if you correlate small cap revenues to CapEx, it's a very high correlation. So, look, nobody knows, and there are a lot of risks out there, but I actually think that this digital disruption and CapEx cycle improving in the U.S. could be very good for small companies.
Candace, does reshoring automatically lead to higher prices? Is it something that we should be exploring more?
Francine, I think the answer, it could, I think, is the answer. However, remember, the reshoring is going to be offset by more automation, which is going to be, not inflationary. You're also going to have things like tax incentives and probably some subsidies, like you saw in Arizona with the TSMC factory being built there. So, yes, we are concerned about the fact that prices could be a bit higher, but there are also some offsets. And the other thing to think about is the fact that if you do move manufacturing back to the United States, each manufacturing job creates somewhere in the area of 6 to 7 other jobs. So this reshoring could be very good for employment in America.
Candace, thank you so much for joining us today. Candace Browning there, Head of Global Research at Bank of America Securities. Now, coming up, as we continue tracking COVID-19 across the world, we speak with Lauren Sauer, Johns Hopkins Assistant Professor of Emergency Medicine. She's coming up next, and this is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Or by natural infection, to get to the point where you really have a veil of protection or an umbrella of protection over the community. That's not going to happen in the first couple of months of availability of vaccine. So we will not be able, I hope we don't, we should not abandon public health measures even when we do get a vaccine.
Well, that was the National Institute of Allergy and Infectious Diseases, Dr. Anthony Fauci. Now, let's get more on COVID-19 as we continue to track the virus. Bloomberg has, as you know, developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, today we're delighted to be joined by Lauren Sauer, Johns Hopkins University Assistant Professor of Emergency Medicine. Thank you so much, Professor Sauer, for joining us on this Wednesday. I don't know whether you worry more about schools reopening or universities reopening, because it needs to be a focal point depending on the number of infections there, or just whether we just need to be in this for the long haul. We just should assume that COVID is here for at least the next 2 to 3 years.
Yeah, I think they're not mutually exclusive, unfortunately. We are worrying about the schools reopening, knowing that COVID-19 will be around, that the virus will be around. And, with the schools, I think everyone's goal is to get the primary schools, the K through 12 schools, back in place as quickly as possible. College kids will be able to adapt. Universities will be able to adapt. We're seeing many move online. But they also are locations, as we've seen in the past few days, that have the potential to create explosive outbreaks. Teenagers, young adults, they're going to make choices that that may exacerbate outbreaks, and oftentimes it's predictable and expected behavior, and we have an obligation to reduce the risk in those spaces.
Okay, but Lauren, this is really important. We're living in real time, and a lot of courageous people here. I don't want to be critical. We have a university where we have X number of cases, and they make a major change in policy. What is an elementary school going to do when 2 students have 2 affiliations with the virus?
Yeah, I mean, it's not fair to the elementary schools to expect that they're going to have a management plan that can deal with these sorts of situations, especially as everyone is sort of going back to their regular activities in fall, and we're going to have a lot of exposures that we may not even have the capacity to do the contact tracing, to track down the origins, to track down the transmission chains. And so, if our priority is getting kids back in school, then our priority even above that is getting community transmission under control, and that means maintaining the social distancing, maintaining these closures, maintaining all these behaviors that we've been up and down with all summer and even earlier this year.
Lauren, why can we not track and trace properly? Is it a funding problem, or is it the technology problem?
I think it's a mix of a few problems sort of coupled on top of each other. There's challenges with trust in our community around public health activities, and so that the fundamental underpinning of contact tracing is that you trust the contact tracer enough to share that important and private information with them. Also, the scale of our outbreak means you need a significant number of people doing contact tracing, and while that scale up is an option, you have to do it. You have to do the hard work that gets you to the place where you have enough people who have the know-how to do the contact tracing. And then just identifying them, it all is sort of underpinned by testing, and we still do not have a national testing strategies. There's been some pitches on some opportunities, but there's been some pooling strategies that don't work because our prevalence is so high. And so until we get a really good individualized national testing strategy that allows us to identify cases quickly, efficiently, and effectively, none of it will work as well as it should.
Lauren, who's getting it right? I don't know if it's a state or another country. Is there anyone who's doing a better job? Is there anyone that has a blueprint for this?
Yeah, I think unfortunately there's a lot of people who are doing it, or fortunately there's a lot of people who are doing, a lot of states and further a lot of countries outside of the United States that are doing a better job than we are here. I'd have to think about who exactly is doing a better job, but we're seeing in many parts of Asia that they're reopening and they're keeping cases low. In Singapore, cases are low. In a lot of countries that managed their first outbreak, their first wave better than us, they've been able to implement the strategies that we just talked about that allow them to keep the cases low, identify the people who have a case, and isolate them very quickly.
Thank you so much, Lauren Sauer there of Johns Hopkins, and be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for exclusive conversations with Johns Hopkins experts for an inside look at battling COVID-19. Up next, well, we talk about markets, and then coming up on Balance of Power and on radio, Cass Sunstein, Bloomberg opinion columnist. That's at 12 p.m. New York time, 5 p.m. in London, and this is Bloomberg.
we are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, we continue to track the markets, and we also bring a great interview that happened earlier on. As we continue, of course, a profile of high-profile Chinese stock listings, which have helped Hong Kong exchanges and clearing post a record profit. Well, Bloomberg's Yvonne Mann actually spoke to the chief executive of that company. Here he is.
Really a happy day for us.